Oh, hey everyone. Good evening. This guy's a quick round of voice check and video check and a screen check. Can you guys hear me properly? Can you guys see me properly? Can I get a thumbs up or all good in the chat box, please? Yes, yes. Okay, yes. Great. Awesome, guys. Thanks for confirming. Okay. I see a lot of you guys are already here. Perfect. Okay, crazy. Lovely. Right. Guys, before we begin, we'll begin in, let's say, next 5 minutes of time. Let everyone just join in. But meanwhile, may I know your trading experience, please? The language for the webinar would be in English. We would be talking in English. Yeah. May I know your trading experience? As in, are you completely new to the market? Couple of months? Uh, 6 years? That's crazy. That's nice. 5 years, 3 years, 0, 6 weeks, no experience, 5 years, 1 year, 2 to 3 years, 6 months, completely new. Since 2019, that's crazy. Last month, 4.4 lakh loss. Great. That's why you're here. Let's see how we can actually recover that. New to the market, zero, new. I see a lot of beginners here. That's nice. Beginner, couple of months, almost new. More than 1 year. Swings, I see 15 years. Crazy. That's crazy. Right. Zero, 1 year, 3 years, 5 years of everything, loss experience. That's all right. You guys are on the right path now. We'll start see that. 4K loss recently. Okay, very good experience in equity swing, but very bad in FNO. I think a lot of people would agree to the same statement that you just made. All right. They're new to the market. Lost 25 lakhs. Lost 25 lakhs in 2 years. Damn, that must have been hard. Emotional trader here. Okay. 1 month made 1 lakh with 7K capital, but lost it all in 1 week. Great. A lot of experiences here, which is probably in futures and options. We'll discuss all of these. 0 years, 0 months, 0 days, 0 milliseconds. That's nice. Okay. I see. Great, guys. I see a lot of you guys have talked a lot of different experiences over here. That's crazy. But before we begin, I just want to talk about, uh, want to learn more about FNO, lost about 6 lakhs in 3 months of time. Yes. So I'll walk you through about the entire path about FNO as well and equities as well. Now, just before we begin, right, just want to set the right expectations with you guys, which is regarding how the, can we record the session? The recording, yeah, the session is being recorded. You guys will be getting the recordings as well. Right, guys, before we begin, just a quick expectation setting regarding the bootcamp itself. Like the bootcamp is structured into a 2 day program, right? I'll just turn off the chat for a little bit and then let me just talk to you, right? So the bootcamp, a couple of expectations we begin out this camp, which is first, bootcamp is structured into a 2 day process. This is day one, that is your induction. The second day is basically purely for intraday trading using smart money concepts and institutional trading, right? That's purely an F1O session. So today's session, day one, is mainly focused from starting from scratch. I know a lot of you guys are beginners. That's completely fine. We're going to start from scratch, absolute basics. Then we're going to make our way into the advanced sessions. So today we're going to focus on the first side of investing, which is we'll focus on everything regarding investing and your positional trading. That's your long-term investing or momentum investing, as we call it. The agenda is very simple. As you know, almost a lot of traders will actually lose money in the market. That's the literal truth. And it's about learning how to actually be a profitable trader. And that's the whole point of the bootcamp. It's to make sure that you guys are set on the right path towards profitability. Now, trading is not an easy journey, but it's actually something that is very exciting. Now, I'm going to walk you through our experience on how to actually crack the markets, and I'm how trading actually works on the backside and how to actually really make money from trading. It's not just about putting some buy order and sell order and just praying to God. No, that's not how trading works. We'll walk you through how to actually be on the right path towards being a funded trader and how to make a career out of trading as well. I'll give you different examples and I'll actually give you the right roadmap to being the same. So a couple of expectations before we begin. First expectation, today, the first half of the session, we're going to cover up as a beginner friendly session. We're going to start from scratch. We're going to learn deep dive into investing mainly in today's session. By the end of today's session, you guys should be in a point where you can identify what is a good investment, what is the bad investment. You should be able to look at different stocks and say, if I can buy into the stock right now, if I should buy it, where should I buy it, and all these things. Basically, we're going to learn about timing the market for long term today. Cool. So today's agenda is mainly for positional trading. That's basically your long-term investing or your wealth side of your portfolio. Tomorrow is purely an intraday session where we focus on derivatives and more accurate strategies, right? So today we're going to start with building portfolios and understanding how to actually make money in the long term. Tomorrow's is purely an intraday business, which is where that's a business side of our income. That's where we focus on improving your accuracy and everything. Great. So with that expectation, first thing I want to talk to you guys about is that the session is being recorded. You guys will be getting the access to the recordings. And I will be giving you bit spaces in between the meetings in which you can ask me questions. I'll clear up those questions, then go to the next part, right? So again, towards the end of today's session, we'll be analyzing different stocks. Whichever stocks that you recommend, we'll actually have a look through them. We'll see what is the right entry point, what is the exit point. My agenda, my goal for today for you guys is that to make sure that you guys will know which all stocks to enter and which all stocks not to enter. And if you're entering, how much to enter, what should be a risk, and putting in the right side for the well side of a portfolio, right? So that's the main agenda for today. Tomorrow is going to be intraday trading, right? So that's the first expectation. The second expectation I have with you guys is regarding trading itself, right? Trading, as you know, it's not first thing, it's not a get rich quick scheme. It's not where you guys make like right out of the boot camp, you guys start investing and you make a lot of money. It's not like that. The reality is you guys will make profits. I'm not saying you guys won't make money. You will make money, but the reality is you're going to make losses as well, right? Losses are always going to be a part of your journey. Think about it this way. Trading is more like a video game. You have a video game where if you perform well in the video game, you can make money. And trading has a set of rules, right? Just like any other video game, you have a set of rules. Follow the rules, you can make money. Step away from the rules, you can lose money. That's the side of thing, right? Which is the rules. Uh, the reason why we break the rules is because since trading is directly related to money, that is, if you perform well, we can make money. If you perform poorly, you can lose money. Because of that, emotions get in the way. You have that tendency to gamble in the market. Even though you have a strategy, you have everything in place, you have that feeling in you, or that gut feeling, or people call it the gut feeling. Yeah. Some people call it hope, right? So it's basically you will just jump into different trades. Since you know that even if it's a small green candle up can make you a lot of money, we have that tendency to jump into trades, or we have that tendency to we have our emotions like greed, hope, and even fear coming into the picture, right? So in simple words, trading is a video game. We have rules, follow the rules, we make money. But because of our brain is going to play games with us. Our brain is going to tell you, buy right now, it's probably going to go up, there's going to be a huge movement up and all these things. That's the tricky part, right? So trading actually involves not just your finding a really good trading setup, it involves psychology, which is training your mind to actually be good. So tomorrow's session, we're going to deep dive a lot into psychology and how to train our brains. And there's also big risk management also in the picture. Again, we'll discuss that as we go along. So this was pretty much the second explanation I want to set with you guys, which is trading has a learning curve to it. It's not like you just make money right off the bat. Just like any other profession out there, you put in your time and effort into trading, and it's a smooth, eventual exponential curve that you have, right? So having said that, I want to set like just a personal opinion, like trading is one of the best skills out there in my opinion. It's because it's directly related to money, and even if you're traveling anywhere, or even if you have just your phone or your laptop with you, you can always have a secondary source of income to rely on. My expectation for you guys is that put in that initial time and effort to get past that learning curve. Put in say 2 to 3 months of effort to just get past that learning curve somehow. Then it's an infinite potential, or it's a lifetime skill that you're learning over there, right? So just get past the learning curve somehow, put in that time and effort, you will see yourself getting rewarded for it. So that's my expectations from my side for you regarding trading itself. Take it slow. It's not where you just make money right off the bat. Put in your time and effort at least for a couple of months, and it's a skill that you will never regret on, right? So so that's pretty much it regarding the session expectations. I will, without further ado, we will start today's session. My agenda for today is to give you the maximum knowledge possible in the next 2.5 hours of time. It's going to be kind of packed with knowledge. Like I would not want to prefer wasting any time. So let's directly get right into it. Okay, cool. So before we begin, let me just quickly introduce myself as well. I think most participants are here now. I'll take a notepad out so that you guys can have it with you during the. I'll give you these notes after the session where you can just go through them later and start executing what we learned. Okay, so first thing, let me just quickly introduce myself as well. My name is Akash Jain. I'm the co-founder of HAVENARK. I've been in the market for close to 9 years now. The slide is outdated. So I've been just like everyone out there, I started my trading journey in my college years. I think it was my first year, second semester. I was just looking for a source of income. I was doing my electrical engineering from VIT, but was never concentrated on engineering like most of us. And I started looking for sources of income. That's where trading came across. There were so many things on YouTube which said 100% working strategy, best way to make money online. All these things were there. I started with a capital of 3,000 rupees, followed the best indicator out there and everything. It became around 500 rupees or 600 rupees in just 2 weeks of time or 3 weeks of time. And but yeah, I had a lot of time with me in college, and that's when also when I met my co-founder Ritvik. We used to trade together. So that 3,000 rupees became 5,000, 10,000, etc. So by the time we were fourth years itself, we started making around 1,000 rupees on average. And that's what, like, it just stick to us. Like, it was a really good fit because, it was just analytical in nature and easy to, it's actually trading is actually kind of easy. It's just the rules are kind of, like hard to follow your emotions. That's the hard part. Anyway, so that 3,000 rupees capital became 5,000, 10,000, 50,000, 1 lakh, 5 lakh, 10 lakh, etc. Right now, we're trading on a 20 crore capital. And I became a partner at this firm called US trading firm called Zintra, which is an asset management company. And we've been funding Indian traders also as part of that. We have funded close to $5 million to different traders out there. And yeah, so we are hoping that our aim is to our vision is to create a new generation of traders and give them the capital for trading. So that's the first thing I want to actually bring about with you guys, which is there's a misconception that people want to just double their capital, right? They just want to go from, say, 10,000 rupees, they want to make it 50,000 rupees, then 1 lakh capital, 2 lakh, 5 lakh, etc. This is actually no longer required. The entire trading world has changed so much, and this is actually not a scalable way either. You can easily lose out your money also, especially in futures and options. I'll tell you the reasons also why pretty soon. What I want to first get you guys into the world of is that in trading, it's no longer about multiplying your capital and all these things. I want the first expectation I want to set is focus on the skill of trading, right? What is more important is skill over money, right? Focus on skill over money for the first couple of weeks. What I mean by this is that what I mean by this is that you can be a funded trader. Funded trading is nothing but once you have the skills, there is something called as a funding exam. We have our own funding exams, which, for example, in our exam, you have to make an ROI. ROI means return on investment. Okay, ROI, that is of 2%, right? Uh, in other words, in the trading world, if you have a capital of 10,000 rupees, and if you make say a 10% ROI, right? If you're making that, you're going to have a profit of say 1,000 rupees with you. And this 10% ROI is not so hard to make. You can actually make this in just 3 or 4 trades of time itself. You can actually make this. But what I'm saying is that make 10% ROI per month. At the end of every month, after all the losses also, if you're able to make this 10% ROI, then that's how you become a proper professional trader. I'll tell you why. So this 10,000 rupees capital, right? The same trade that you took, the same trades that you took to make 1,000 rupees, if you were investing 10 lakh into it, this would have given you 1 lakh in profit. The same trade, if you're putting it, say 1 crore into this, you would have made 10 lakhs in profit. In other words, trading is scalable. It doesn't matter how much the capital doesn't matter. The same trade, if you're putting in more capital, the more profits that you make. Cool. So the same trade, if you're making 10 crores into it, you'll be making 1 crore into it, right? So the idea is simple. Just focus on the skill of trading. This money part, right? Prop firms like us, we will give you the money for trading. That is, like if you're able to, how the funding industry works is that if you actually make an investment, you'll be given a simulator. And if you can prove that you can make a 2% return on capital like this, then you will get $10K in funding. That's around this is the minimum capital. That's around 82 lakhs, right? With this capital, if you make a loss, right, that's covered by the firm. If you make a loss, that's completely on us. If you make a profit is usually split up to 85% for the trader, 15% for the firm. Okay, this is how trading works nowadays. In our case, how it works in our firm is that from $10K, if you're able to achieve this, once you become funded, if you are able to make 2% profit, prove that you can consistently make that in a month, then you get 10K. And if you can do that every month, it goes to 30K, 50K, 100K, etc. Like till $100K, it's 100% payout for the trader. This is our firm. I'll tell you about how it works in other industries also. 100% payout for the trader. Like we don't take any money from you. Like our objective is to make sure that you get as much scaling as possible. And once you're on a $1 million capital and everything is when the same thing happens, right? So once you're on a $100K capital, if you're able to make 2% in the same month, you'll be walking away with say $2,000 in capital profit. This is just the quick math about how the funding industry works. Our funding is mainly for the US markets. It's there in Indian markets as well. But Usually the funding programs are mainly in the Forex market. Forex market also is filled with funding programs. It's the same thing. Focus on the skill of trading. Here you have to make a return of close to 8% in a month. Okay. If you can make this, you can get funded. How it works is that you can get funding up to say $200K, right? In 200K dollars, the same thing, profit split is say 85% for the trader and 15% for the firm, right? So once you're on this, on a $200K capital, if you're able to make 10% capital, if you're able to make 10% ROI on this, this is basically going to be a 20K payout for you, right? That's in dollars. So just wanted to give you the right expectations before we start out. That is, I don't want you guys to put in your own money into trading. The industry has changed. Just focus on the skill first, get trading profitably, even with a start out with just 5,000 rupees, right? Your initial capital, what I would recommend is just 5,000 rupees, right? Start with 5,000 rupees. See if you're, even if it's 3,000 rupees also, it's completely fine. See if you're able to make 10% or 5 to 10% ROI per month. In a month's time, make 500 rupees or 800 rupees. If you can do this, you are on the right track, right? So then you can apply for these funding exams and everything, get funded, replicate the same process on these funded accounts, get your payouts. Cool. So first thing, I don't want you guys to put in your own money anymore. Just follow the funding exam models. Focus on the skill first. Money will eventually follow. Cool. So this is the career path for most traders out there. And this expectation, I think we can go forward with learning about trading properly now. Right. So now you know how trading industry works and how you can actually have a career path out of this. Let's start with the topics for today. All right. So before we dive into the markets properly, let's first have an understanding about what financial markets are. Okay, financial markets. In other words, let's look at a farmer's market. Okay, to understand the financial markets, let's look at a farmer's marketplace. Okay, in a farmer's marketplace, there are three components. There is the buyer. Let's say there's a seller. That's the farmer. The farmer comes to this marketplace. He wants to sell his vegetables and fruits into this marketplace, right? He just lays out his table and everything. He wants to sell his vegetables and fruits in the marketplace. Similarly, there's a seller also. There's a buyer now. Buyer is nothing but the consumer or me. I am going to this marketplace. I want to buy vegetables and fruits of this farmer over here, right? So what I want you guys to notice is that there are three components over here. There is a buyer who is buying something. There's a seller, and there's a marketplace where this exchange is happening, right? That's the three components. And the product is also there. That's vegetables and fruit. Now change the product in this case. If the product is fish, right? If it's fish, then it becomes a fisherman's marketplace. If the product is wood, that's a lumberjack's marketplace. If the product, so depending on what the product is, we have different marketplaces. If it's plants, it's a plant marketplace. So depending on what the product is, we have different marketplaces, but the structure is always the same. There's a buyer, there's a seller, there's a marketplace where this exchange happens. So if the product is financial securities, okay, there's a lot of fancy terms that the finance people use. One of them is securities. Security simply means any type of financial instrument, meaning this could be a fixed deposit, it could be stocks, it could be cryptocurrencies. All of these are examples of securities. Securities is a broad name given to any kind of thing where you can invest your money in. That's securities. Okay. So in other words, if the product is financial securities, then it's the financial markets. So think about it this way. Financial market is the biggest umbrella. Okay. It's an umbrella where there are different stock. There are different markets under this umbrella. So depending on what the product is, for example, if the product is, let's say, stocks or shares of companies, right? Shares of companies. This is what we call as the equity market. This is what we call as the equity market or stock market. In the finance world, even if you look at the news and everything, they don't usually call it the stock market or share market. They use the word equity. Equity is the right word to use when it comes to the finance world, right? Equity means ownership. The literal meaning of equity is ownership. You're buying ownership of a company. Think about it this way. A stock market is a place where if you want to buy a part of the company, if you want to be a part of the company, you can buy shares of that company. That's what the stock market is. We'll deep dive into it properly once we talk about the other markets as well. Here, the timing for the market is it opens at 9:15 a.m. and it closes at 3:30 p.m. Within this time, we can enter and buy in different just like any other marketplace, market is open from this time to this time. We can buy and sell different shares of companies. We'll deep dive into stock markets pretty soon. Anyway, that's the stock market where you can buy different shares of companies. The second one is what we call as the fixed income market. Okay, fixed income market or we call it the debt market or credit market. It's all the same, debt or credit. Okay. So here, now this is kind of interesting. Like we all know about the fixed income market, just that we never realized it. This is nothing but a most popular example of this would be your fixed deposits, FDs. Okay. As you know, everyone loves FDs, especially in India. It's because the main thing is it's safe. Everyone talks about safety, guaranteed returns, right? Guaranteed returns meaning that these FDs gives you an interest rate of say 7%, which means that if you put in 1 lakh of investment, at the end of 1 year of time, this 1 lakh will become 1.07 lakhs, right? Which is nothing but close to 7,000 rupees in profit. This is your fixed deposits. Interest rate is there, and these are also taxable. You have to pay tax on top of whatever you earn over here. Cool. Now the reality is FDs are the worst instrument when it comes to fixed income market. There are so many other things, but people don't know about it. Right? There's a knowledge gap. So let's learn about the other ones. Just like fixed deposits, just like the safety guaranteed thing, right? Even fixed deposits are not completely safe. If the bank closes, like especially when it comes to small finance bank like Ujjan Small Finance Bank and etc., they will give you at least say 8% FD and everything. But the risk is that if these bank fail, you're only liable to get 5 lakhs in safety. As in, if you up to 5 lakhs, you can recover the money. If it goes above that, if the bank fails, they're not liable to pay you. So there's a safety risk in fixed deposit as well. So there's something called as government security bonds. That's the second kind of things, bond market, right? Government security bonds or GSEC bonds. Okay. This is basically the safest out of them all. When the government of India wants to construct a new highway, for example, National Highway Authority of India, when they want to put a new highway in, they don't take money out of their treasury and just put it into the roads just like that. Instead, they issue bonds to the public. The public can invest into these bonds. In other words, give an interest rate close to 9% or 10%, right? Higher than a fixed deposit. These are considered to be the safest of them all. Only if the government of India collapses, only then these bonds will default. Right? These are the safest, even better than fixed deposit, and these are tax free also. You don't have to pay on any tax on top of the interest. Like fixed deposit, you have to pay 30% slab on top of whatever you earn, but government bonds are even tax free. So interest is higher and it's tax free also. Much better, right? I'll show you where you can buy all these things also pretty soon. Anyway, similarly, there are other bonds also. Where even there are something called as corporate bonds. That is when big corporates, right, when they want to invest into different companies, they don't have to put in, they don't put in their, when companies wants to expand also, they don't take money right out of their pockets. Instead, they issue bonds to the public. Here, they can get an interest rate of close to 11 to 12% also. Almost twice of that from what you'd get from a fixed deposit. But these are relatively safe. That is, if the company fails, there's a risk over there. But if the company fails, they will dilute their assets and they'll get your money back. So, but there's also a safety factor over there. So there's a problem of picking the right company stocks. I'll show you how to do that also. These are taxable on top of it, just like a fixed deposit. So the first thing I want you guys to understand is that the main thing is that instead of thinking fixed deposit, the first change that I want you guys to have is that in fixed income market, there are so many other options than fixed deposit. Corporate bonds and government security bonds are a good option. So let me just show you where you can buy all these things also. There's a lot of websites that I'll be introducing you guys to today. The first one would be, say, wintwealth.com. This is for your corporate bonds. Wintwealth is an initiative by Zerodha itself, which is the largest broker house in India. So Wintwealth, basically, out of all the corporate bonds, they pick out the best ones, right? The safety ones. And you can see this basically shows which are the live bonds and everything. This is currently Neo Growth. It's giving 11.5% interest. You can see Navi is there at 10.5, Spandana is at 11%. All of these are there. These keep getting sold out and everything. Like in the past, you can see so many other bonds were there. It all got sold out. Everything is around 11%, 11.75%, as you can see over here, right? So these are pretty good bonds that you guys can check out. And here, if you look at the details here, you will see the minimum investment amount required. Okay, here the minimum investment is around 1 lakh, but there are some bonds which starts at 1,000 rupees as well. You can see Navi is at 1,000 rupees minimum investment. Okay, there's also something that you can notice here, which is one sec. You will see the interest payment also. Okay, you can see the interest is paid out monthly. Okay, so here's one of the commonly used strategies. Some bonds interest is paid out every 3 months. Some bonds interest is paid out monthly. Some bonds it's even quarterly. Half yearly. every 6 months, the bond may get the payout, right? So here's a couple of strategies that most working people do. If you're a person with a low risk appetite, right? For a low risk appetite, I'll just put in the website name here itself, win12.com. Pretty good website. Do check it out. You can start with a minimum investment of 1 lakh, 1,000 rupees as well. If you have a low risk appetite, one of the common things that people do is that, oops, if you have a very low risk appetite, what you can do is that your main investments, you can use corporate bonds. Okay. Put money into corporate bonds. Okay. Into corporate bonds, get that 11% returns and everything. You will get a monthly interest, right? This monthly interest, you can rotate it to stock markets. So if you want aggressive returns at the same time, you don't want to play, you want to play it 100% safe. In that case, this is for you. That is, use bonds, find the interest, get monthly interest out of them or even quarterly interest. Whatever you earn as interest, rotate it out of the stock market. So you're never losing your capital. At the same time, only the interest is giving an aggressive return from the stocks, right? A simple method that most people use, for a lot of working professionals use to actually get better returns than your normal fixed deposits, right? So this is the first thing. This is your win12.com. Just check it out. If you want to do government security bonds, there's this website called the fixedincome.com. I'll just put it in the notepad as well. This is for fixedincome.com. So here, this is for your corporate bonds. I mean, you'll find all bonds out here, but I prefer it only for corporate bonds. Check out the bond section over here. You'll find government guaranteed bonds. This is your corporate government bonds, right? So you'll find 9.70% is being given by Uttar Pradesh Power Corporation. These are your state bonds. Kerala is giving around 8.95% for infrastructure. You can see 7.60 for Food Corporation. Bharat BSNL is giving around 7.51, 8% for Mahanagar Telephone. Andhra is giving around 9. Meghalaya is even giving 11%, right? That's crazy. So there's also one key drawback for these. That is, minimum investment capital may range from 1 lakh in case of Kerala. Some of them are 10 lakh also, right? So minimum investment in government security bonds are usually around 1 lakh. That's the only drawback for it. But yeah. So our main agenda for the bootcamp is basically the stock markets, but this is actually an important thing that you have to know when it comes to your investments. That's why we're discussing this. So the first thing I want you guys to understand from the fixed income market is just this fact. Instead of thinking fixed deposits from now on, start thinking about bonds. If someone is recommending to invest into FDs, ask them to talk about bonds instead, right? So that's just a small mindset switch that I want you guys to have. There is a big knowledge gap here because earlier bonds were not accessible to people. A minimum of 50 lakh investment was required back in 10 years back and stuff. That's why fixed deposits were more popular. But now Win12, fixedincome.com, everything has made it much more accessible. So go for bonds. Cool. So that's just the thing about bonds that I just wanted to talk about. Let's get back into the session. We'll focus mainly on the stocks itself. We'll focus mainly on the markets itself. Great. So that's just about bonds. Do have a go through a look about these things. And if you have a low risk appetite, try to use the strategy as well. Cool. Okay. Next up, we'll talk about the next market. So, sorry. Cool. So apart from this, that's just about the fixed income market. Apart from this, we have other markets, like there is something called as the Forex market. Okay. Forex market, also called as the currency market. You may hear it somewhere or the other. So Forex market is a 24/7 market, meaning 24/5 market, which means that it's open 24 hours in a day. That is, even during night, it's open, and it's open from Monday to Friday. Okay. This is the international market. It's the biggest market in the entire world. Almost $5 trillion of transaction happens every single day. Transaction every day. So this is where all the big banks, even the governments itself, is actually involved into this entire market. Forex market is huge. It's traded all across the world. And let me just show you what Forex market simply means, right? So in simple words, what you can see is that this is, if you look at USD to INR, right? $1 is around 83 rupees or 84 rupees. But if you look at over time, past year it was around, say, 76 rupees, 79 rupees. This kept going up and down. If you look at, say, USD to euro, right? $1 is right now, say, 0.92 euro. But over time, you can say at one point of time it was 1.03, one point of time was 0.84. Every currency has a different value, right? This is what we call as the Forex market. So every currency pair has different values. If you look at USD to Japanese yen, again, $1 is 160 Japanese yen. This is the Forex market. This is the biggest market in the entire world. It's the international market. And the funded programs that I talked about is actually in this market as well. Okay. So we'll talk about Forex market in depth a little later as well. Then we also have the crypto market. Everyone is against cryptocurrency nowadays because of the big crash that happened 2 years back. But in reality, every market has a market cycle. It's a good time to start investing into crypto as well. Cryptos follow a 4-year market cycle, as we call it, 4-year cycle. Every 4 years, there's going to be a bull run and a bear run. What is bull run? What is bear run? We'll talk about in this session. Stock markets follow an 8-year cycle. Crypto markets follow a 4-year cycle. So every 4 years, there's going to be a huge crazy about bitcoins and everything happening, and then there'll be a huge crash following that also. So what usually happens is that when the crash happens, people call bitcoin a scam and everything until the next boom up. Okay, the next boom is actually in its early stage right now also. The next boom is happening right now. So I'll tell you which cryptocurrency coins to invest in all these things towards the end of today's session. I'll give you a portfolio for investing. Anyway, that's crypto markets. Crypto market, again, this is a 24 hours market into 7, meaning it's open even right on Sundays also. It's even open. So right now also the crypto market is open. You can trade it. So I usually prefer trading crypto market in the night, as in if you have 1 hour before sleep, if you just want to play around with some money, crypto market is actually a fun way to go. So again, we'll deep dive into what good time is there to trade the crypto market and everything as we go along. But one thing I want you guys to notice here is that even if it's Forex market or crypto market, let me just show you the charts for it. Yeah. Let's have a look at Forex market, for example. This, you know what, let's start with Indian stocks, right? This is Nifty 50s chart. Let's take Axis Bank, for example. Okay. So Axis Bank, a quick introduction to the graph for the beginners. X-axis is your time. Y-axis is your stock price, right? We'll see there are different time frames and everything. We'll talk about that as we go along. Just right now, you can just see that these green candlesticks simply means that the price is going up. Red candlesticks means that price is going down. We'll deep dive into what each of these means a little later. What I want you guys to notice is that this is a chart for Axis Bank. Okay. Looks clean. Now let's have a look at chart for Forex. Maybe, where's Forex? Let's have a look at, say, a Forex currency pair, Euro USD. 1 euro is how many USD, right? Right. So now this is the chart for Euro USD. Or let's look at USD Japanese yen. $1 is 160 Japanese yen. Okay. So what I want you guys to see is that if you didn't know this was USD to Japanese yen, you would not know if this is a stock chart or a Forex chart, right? Similarly, let's look at a cryptocurrency chart also. Let's see if there's any big difference from it. Where's crypto? Okay. Let's take, say, Ethereum USD, right? Even this has a chart to it. If you look at this chart also, it's just green candlesticks and red candlesticks going up and down. Same thing. If you were just looking at this side of the thing, you would not know if it's Ethereum or if it's Forex chart or stock chart, right? So what I want to get to you guys is that it doesn't matter what market we trade. If you're trading Forex market, crypto market, or anything, trading is nothing but looking at a chart, understanding what is a good price to enter, if the price is going to go up or price is going to go down. This is what trading is. In simple words, trading is nothing but you look at a chart, you have an intuition now. You use different strategy, you analyze the chart in depth and everything. We'll learn about that in today's and tomorrow's session. But you use different strategies and you figure out if the stock price is going to go up. If it's going to go up, what should be my risk? How much should I risk? How much should I target, or how much profit should I try to capture? That's what trading is. In other words, it's like betting, right? You're going to bet if it's going to go up or if it's going to go down. Unlike for beginners, especially, like, we usually have the tendency that we only make money if the price goes up, right? But in reality, in trading, you can bet in both directions. If you think the price is going to go down, you can make money when the prices crash as well. That is what is called as shorting or short selling. We'll learn more into this later on as well. So in trading, it doesn't matter if you're going to go long or it doesn't matter which direction you're betting in. You can bet in both directions. If you feel the price is going to crash, you can short sell it and you can make money when the price crash as well. If you think it's going to go up, you can make money when the prices go up also, right? So trading is nothing but figuring out, looking at the charts, analyzing. It could be the Forex market, could be the crypto market, could be stock market, doesn't matter. You analyze the chart, figure out what is going to happen on this chart, then place your bet in that direction. So it's basically like you're betting that it's going to go up. If your analysis is correct, you make money. If your analysis is wrong, you can lose money, right? You can lose money as well if your analysis is wrong. It goes down instead, you lose money. But when you're losing money, you have to make sure you lose only a certain amount of money. That's what risk management is. So this is the crux of what trading looks like in short. but we'll deep dive into how all of these works and how to analyze all of these things one by one. Great. So that's just a quick intro on how the charts and everything works. Let's get back into the main session. So all right, so that's pretty much most of the markets, crypto market, forex market also. There is also one more market that you guys should be knowing about. This is what is called as the futures and options market, FNO market. Okay, this is where 99% of traders lose money. Okay, this is the FNO market. Okay, futures and options market, FNO market, right? This is the high risk, high reward market. Okay, it's definitely not for beginners. Beginners, please stay away from it. High risk and high reward market. Okay, FNO market is basically very attractive because if you put in 1 lakh, you have the option or potential to make 1 lakh in a single day. You have the option to double your money in a single day's time, right? That's very attractive. Like in the normal stock market, the returns that you can expect is like if you're putting in 1 lakh, you may be able to make around say 2,000, 2.5K to 5K in a day's time, right? In a decent good trade, you'll be able to make that. But if you're making a loss also, your loss would be around say 1,000 rupees or 1,500 rupees, like max loss and everything. Uh, so this would be like what a normal stock market trades looks like. But if you're trading the options market, right, with that same 1 lakh market, FNO market, if you're using that, that same 1 lakh would be giving you say a 20K profit on an average. A 10 to 20K profit would be something that you can look at average, right? 20K profit. Whereas if you make a loss also, you'll be making between say 7K to around 15K losses, right? Big losses, but at the same time, big profits as well. Again, you can get lucky and double your money also in a single day's time. A lot of things are there. Also, you can lose your entire capital, lose that entire 1 lakh also in a single day's time. Everything can happen in the FNO market. So first of all, beginners out here, do not ever step into the FNO market until you have mastered risk management and your psychology, right? First step, stock market. Figure out how your ROI works. That is, if you're able to figure out one strategy, replicate that strategy, see what is the accuracy, find how much ROI you're able to make, master risk management and psychology, then you can get into the FNO market. Now, realistically, if you want to master FNO, stock market, you can master in between, say, 3 months to 6 months of time. On an average, 6 months is what you can use to get profitable in the stock market. Like I've seen people get profitable within just the first month and the second month also in stock market because risk is very lower. But when it comes to the FNO market, you should expect yourself to be profitable only after 1 to 2 years of time or even more sometimes, right? If you want FNO market, if you want to focus on high returns like this, it will definitely take you time because this requires mental fortitude. What I mean by this is that if you are trading on a 4 lakh capital, right, you should have that mental fortitude or that mental balance. You might be seeing 1 lakh in loss in a single day's time, right? And you need to have that mental strength to actually get that. And if you make a loss also, if you want to get back into the game, if you can also lose that entire 4 lakhs. It's about how you get back in the game, right? So that requires mental fortitude and it's a very hard way to go. This will definitely take you around 2 years of time to master. So just to give you a quick understanding about why FNO is very risky and the trading journey as well. That is, in a normal trading journey, right? You have that euphoria phase. FNO traders, they may start with say 10K dollar cap, 10K 10,000 rupees capital and everything. This may become 20,000 rupees in just a couple of days' time. This is the euphoria phase, 20K or 30K and everything. Euphoria phase. They start thinking about Lamborghinis and big mansions and everything. And then eventually market reality kicks in. Overconfidence comes into the picture. You start making continuous losses. Here is where most traders quit. You'll be making a huge loss. You will definitely wipe out your capital. Most traders will quit over here. Okay. It's about getting back up from this and making sure that you get back on the game. And it's going to be a slow growth after that. You will have the different mindset. In the first scenario, you'll have an aggressive mindset to double your money. In the next time you're coming into the markets after this 1 year of time, you have a matured mindset. That is, you're not targeting for 100% returns. You're targeting for constant good percent returns every single month. And it's going to be a slow growth after that. That's usually the cycle for an FNO trader. Now, just to give you a maths about why FNO is very risky and everything, this has happened so many times between different traders. I'll just tell you, okay, they'll make you even the best trader out there, let's say an 80% accuracy or 85% accuracy trader, right? They'll make 1 lakh into 2 lakh, they'll make into 5 lakh, they'll make into 10 lakhs, and they'll lose this entire capital in just 1 week of time, right? They'll lose up to 80%, like 8 lakh loss will come in just 1 week of time. The thing is, you have to understand there's something called as, even with an accuracy of 85% accuracy, okay, 85% accuracy, there's something called as Monte Carlo analysis, which is a simulation of 1,000 different trades. Okay, 85% accuracy means that almost 9 out of 10 times you are right. You are the best trader in the industry, right? But if you have 85% accuracy, even then you have a chance of making 8 consecutive losses. You have to be prepared for this drawdown limit, 8 consecutive losses. This is maths, right? So if you consider the same sample size over thousands of different trades, this may come in after say 5 years of time also. But at one point of time, you're going to make 8 consecutive losses, right? And if your risk appetite is very big, usually in FNO traders, you can see with 1 lakh capital, they may be risking around 10,000 per trade. That's a 10% risk. If you make 8 consecutive 10% losses, 80% gone. All your capital will get wiped out. This is the reality of FNO trading. So if you can't master your risk management properly, you cannot be in the FNO market. Right. So this is why FNO is really hard. I'm not saying it's impossible. It is possible. You'll be talking to Ritvik tomorrow, who has mastered FNO trading, and he'll walk you through the right mindset and methodology for cracking the FNO market. That's going to be tomorrow's session. Cool, guys. So I think we have the right expectation. For me, from my side, start with stock, especially for the beginners. Start with stock markets, find your ROI, find your accuracy. Then slowly, once you're really confident, start getting into FNO market. Don't get that way. And you don't have to get into the FNO market also directly. That's also fine. You can just get into the funding programs. That's what I would suggest. You can just avoid the entire FNO mindset itself. If once you have achieved consistency and profitability, just go for a funded program. These may look like small figures to you right now. 2,500, like 2.5% may look small, right? But if you are doing the same thing on, say, a 10 lakh capital or a 1 crore capital, it's a much bigger account size, right? It's going to be giving you around, say, 2.5 lakhs every trade that you take. So that's the mindset that I want you guys to have. Focus on small, consistent gains. Once you have that, become a funded trader. Awesome. So now we are good. I think uh, I think a lot of the mindset conditioning is done. I think you guys know what is the right path to follow, and it's up to you if you want to follow the FNO path. Also, completely on you on what kind of trader you want to be. If you want to be trading the forex market, crypto market, depending on your time schedules, you can be whichever style of trader you want to be. Okay, so now let's dive into how all of these markets work. That is, how to actually let's talk a little bit about the basics about these markets, and then we'll dive into how to use these markets to make them highest returns. So the first thing we'll talk about is the stock market or the equity market. Okay, so when you think about a stock market, first thing I want you guys to think about is a supermarket. Okay, you just entered a supermarket, and on the shelves of the supermarket, you can see this. You can see Kurkure, Lays, and all these biscuits and all on the shelves, right? So imagine the same supermarket, but instead of Lays, Kurkure, and other biscuits, you find different companies on the shelves. You can find Tata Motors, HDFC Bank, Adani, all these different companies are on the shelves of the supermarket, right? Whichever company you want to be a part of, whichever company you feel will become big in the future, you can take those companies and put it into your basket, right? So this basket that you have, right, this shopping cart that you have, this is what is called as your portfolio, your personal collection of stocks. Okay, your personal collection of stocks is your portfolio, right? So whichever company you want to be a part of, whichever company you feel will become big in the future, put your money into that, and it will also grow. As the company grows, even your money will also grow. That's the concept behind investing. So uh, that's what stock market really is. And this supermarket that we entered, right? The supermarket is what is called as a stock exchange. Okay. A stock exchange is the supermarket where you can buy and sell different shares. In India, we majorly have two stock exchanges. One is NSE, National Stock Exchange. Second one is BSE, that is Bombay Stock Exchange. These are just two different supermarkets. If you want to buy the same share of Reliance, you can buy it from NSE market or BSE market. Like if you want to buy Kurkure, right? You can buy it from Big Bazaar or Reliance. Doesn't matter. Similarly, same share you can buy from NSE market or BSE market. Just two different supermarkets. And it's not just NSE and BSE. There are so many others also. There is Metropolitan Stock Exchange, Kolkata Stock Exchange, Madras Stock Exchange, Bangalore Stock Exchange. Bangalore Stock Exchange used to be there, but it's shut down. Kochi Stock Exchange. So many other supermarkets are there, right? Just that NSE and BSE are the biggest one, right? BSE used to be the oldest one, but NSE is the more new gen one. Like BSE was founded back in 1875. Like you had to, if you want to buy some share, you had to go to the stock exchange or your broker, give cash. They used to give you a certificate which said Akash Jain owns 100 shares of Reliance at this price and everything, right? That's a physical certificate. If you want to get your cash back also, you give the certificate back. This was how it worked back in 1800s and everything. But NSE came up in 1990s. They came up with a fully automated electronic trading system. 1990s was the time of the internet era, and internet was booming up, obviously. So they said that, NSE said that, guys, don't come to the stock exchange anymore. Sit at home, buy the stocks by yourself. right? This is what we use nowadays. That is, if you see your demat account or your brokers, like Zerodha, for example, right? It's like if you want to buy a share of IRCTC here, all you have to do is just click on the buy button, right? Once you click on the buy button, you have an option intraday. If you want to trade intraday, you click on the intraday option. If you want to buy long term, buy for long term, right? Just click on, say, if I want to buy 100 quantities, I require 1 lakh rupees. Okay, that is 1,000 rupees multiplied by 100 quantities, 1 lakh rupees. So your demat account is like a Paytm wallet. You add funds into your trading wallet, and then with that funds, you can buy different company shares. Cool. This system that you see in front of you. This is what was introduced by NSE, and obviously everyone started using NSE. So even though BSE was the oldest stock exchange, NSE quickly became the biggest stock exchange in India. Okay, I'll just open up a chat for this while, which is there's this benchmark index is Nifty 50. I'm pretty sure you guys have heard about Nifty 50 somewhere or the other. Can you guys define Nifty 50? I'm looking for a particular word in the definition. Let's see if you guys can get that. Okay, what is Nifty 50? What is Nifty 50? Top 50 companies. Top 50 companies, yes. It's an index. Yes, index is nothing but a collection of stocks. I'll just put it in the notes here itself. Okay, index is a collection of stocks. It represents India. Okay, top 50 companies in India, collection of stocks. Blue chip companies, top 50 companies with market cap. Nice, nice. Index define the state of the market. Top 50 market capital companies. Nice. Top 50 companies with highest market cap. Nice. A couple of you guys have got this right, which is Nifty 50 free float market. Nice. A little more in depth into it. Nice. Flagship of NSE. Yes. The main market index for NSE is Nifty 50. Yes, that's correct. All right. So thanks for all the answers, guys. So there's this word that came up during one of the definitions here, right? We're talking about how the Indian market is performing as a whole. That's nice. It's an index. Like Nifty 50 is the benchmark index, which basically shows the strength of NSE market. Right? Nifty 50 is used in NSE. If you're looking at BSE market, they use Sensex 30. Right? Just Sensex is for BSE, Nifty is for NSE. Okay. So it's the benchmark index of India. Benchmark index of India simply means that it's the most important 50 stocks in India. As you guys said, it's top 50 companies by top 50 companies of India by market cap. So there's a new word that comes in, which is market cap, right? Market cap, top 50 companies meaning take your Adani, HDFC, ICICI, and all these big companies, put them under one basket. This basket is called as Nifty 50. Okay. And this Nifty 50 companies, the top 50 companies by market cap, if you put in, say, the word came in, that is market cap, right? Market cap means market capitalization, right? Capitalization. In short, we call it market cap. This shows the market value of a company. Okay, what does this mean? You may have heard Apple is a $1 trillion company, Tesla is a $1 billion company, Amazon is a $1 trillion company, Nvidia is a $1 trillion company. They're basically talking about the market cap company. Market cap literal definition is total number of shares of that company, total number of shares multiplied by stock price. Okay, that's the literal definition, but how we look at it is a little different. Let me just show you something. So here's the next website I want you guys to follow. This is called as screener.in. Okay, screener.in is very useful when you want to compare different companies' financials and everything. Let's just go to the screens tab over here. Okay, let's go through one sector. Let's look at the banking sector, for example. Okay, so I know there's a lot of numbers on the screen. Don't worry about it. All of these are used for fundamentals, which we'll discuss a little later. But just look at the market cap column over here. Okay, market cap means market capitalization. You can see HDFC Bank market cap is 12,53,000 crores. Okay, 12,53,000 crores is the market value of a company. So if you want to, market cap represents who is the industry leader. HDFC Bank is the biggest bank in India, which has 12,53 market cap. ICICI Bank has 8,67,000 crores. State Bank has 7,67. And as we go down this list, right, we can find different companies. Like there are companies like say Federal Bank, which is 49,000 crores. If I go even further, you can find Equitas Small Finance Bank, which is 10,000 crores in market cap. If you go even further, we can see Dhanlakshmi Bank with just 1,080 crores in market cap. So based on this, there's something that we can observe. Different companies have different market caps, right? In other words, based on market cap, we have different types of companies. So based on market cap, we have three types of companies. We have large cap companies, we have mid cap companies, and we have small cap companies. Okay. This is the first thing we have to know for investing, which is if the market cap is greater than say 20,000 crores, we call them as a large cap company. Okay. These are considered to be safe investments. Again, I'm calling it safe, but it's not actually safe. But these are considered to be safe investments because it's a large cap company, right? It's an established company. You may have heard blue chip companies, right? Blue chip companies are the big large cap companies are called blue chip companies. So these are established companies in the sense HDFC Bank, even if something bad happens to the entire banking industry, they have so much bank balance that even 50 years down the lane, they will still survive, right? That's why they say it's safe investment. Like down the lane, these companies will still survive somehow or the other. That's why we call it safe investments, right? On an average, returns that you can expect on these kind of stocks is around say 15% per stock per annum, right? That's your large cap companies. These are used for wealth preservation. I'll tell you what wealth preservation is pretty soon. So similarly, we have mid cap and small cap as well. These are what we call as aggressive stocks. Okay, aggressive stocks. These are used for wealth creation. In other words, mid cap and small cap is where money is made. Okay, what I mean to say is that if you invest into you would have seen many memes of Apple saying if you invested in Apple back in 1900s, it would have $100 would give you $1 million by now and stuff. Similarly, if you invest into Apple today, that's not going to make you a millionaire. It'll give you, it's a large cap company right now. It'll give you 15% per annum. But in reality, if you look at it, there are still Apples and Amazons out there, but it's not there in the large cap sector. The mid cap and small cap sector is where the growing companies are. If you put your money there, once the company grows and becomes a large cap company, that becomes a multi bagger in the sense it will give you big, huge potential returns, right? So your mid cap companies are those companies where these are growing companies. If the market cap is between, say, 5,000 crores and 20,000 crores, we call these as mid cap companies, right? These are growing companies. These are not completely established. They may or may not, in 10, 20 years of time, they may exist, they may not exist. That's why they're called riskier companies, right? Uh, on an average, the returns that you can make in large cap sector is around average returns is close to 25% per annum. Okay. Similarly, large small cap companies also do exist, which is if the market cap is less than 5,000 crores, these are small cap companies. These are small companies which may or may not become big in the future. The returns that you can expect as the risk increases, the returns also increase. You can expect up to 35% per annum into these kind of stocks, right? So your mid cap and small cap sector is what gives you aggressive returns. When the markets are booming, these gives the highest booms. When markets are crashing, they have the highest lows also. They give the lowest, they crash the highest also. That's why it's called aggressive stocks. Now, where should we put our money in and why should we put our money in? Okay, so first thing I want you guys to understand is there's something called as risk profiling, age profiling based on risk profiling, okay, on age. So this is a based on textbook says this, but it's not theoretically right. But let me just tell you what it is. That is, if you are between, say, say, 18 to say 35 years of age, okay, we say that you have a high risk appetite. You have a high risk appetite because even if something bad happens to your financial investments, you still have 20 years of work life ahead of you before your retirement. You have a long way to go before retirement. So you can easily make back that money, right? So at this point of time, almost 70% of your investments should be in the mid cap and small cap sector. You should be aggressive in nature. You have a high risk appetite. The rest 30% you can play in the large cap sector as well. Whereas if you are above 50 years of age, right? At this stage, 50 years of age, at this time, you have a low risk appetite. Reason is you have a family to depend on you. You're close to retirement. You don't have much work life ahead of you, right? So you have to play it a little more safer. In this stage of life, almost 70% of your funds should be in the mid fixed income market. You should not be investing in much in the stock market. Like your bonds and everything should be where your main investments are. The rest 30% you can actually play around in the stock market also. But almost 70% of that, this is the 70-30 rule, by the way, 70% of that should be in the large cap sector. With the small 30%, you can play around in mid and small. This is the usual stock allocation when it comes to, based on age. Okay. Now, even though I said that it's based on age, depending on you as a person, if you feel that you have even if you're 18 years old and you have a low risk appetite, like it gives you anxiety if you see some small losses in your portfolio, then it's fine. You have a low risk appetite. There's no compulsion that you have to follow the textbook version itself. You can just go for fixed income market with 70% of it, and 30% you can invest in the large cap sector. Just play around however you want it. Okay. So generally, this is what a mid cap and small cap portfolio would look like. I'm just holding one stock of each because I've exited my portfolio. But just check this out, okay? I'm going to tell you a lot of rules of the market based on this. This is a 2-year-old portfolio. I invested in last 2 years of time. You can see Cochin Shipyard, Masdok. These two are exceptional cases because they've been rallying up very high, but 1,000% or 993%. But the rest of them is a normal percentage returns that you can see, right? What I want you guys to understand here is that these are most of the companies that you see here are not large cap companies. All the companies that give you these kind of returns, like 200 or 400% returns and everything, these are going to be in the mid cap and small cap sector. In the same time, large cap investments like State Bank of India, which was still a good time that I invested in, gave me around 138% investment. ITC gave around 106% returns. When you look at, say, EID Pari, ICICI Bank, right? All of these just gave me around 78% returns in the same amount of time. What I want you guys to notice is that in the same amount of time, mid caps and small caps gives you 100 plus or 200 plus percent returns. Large caps gives you the smaller returns, right? So this is why, like you can see, Airtel also gave me around 76% returns. Other large cap like Hudson gave around 34% returns, right? So this is the first thing that I want to convey, that most of your money should be in the mid cap and small cap sector, and choosing the right stocks and everything. That's part of today's session. Like I'll tell you how to actually time the markets in order to find these kind of stocks, right? I want to introduce you guys to two rules of the market first, right? First of all, I want to break a lot of myths in the market, right? There's a lot of things that people talk about, like large cap investing is safe, like, buy into the best top 50 companies and everything. You'll always make money. None of them is true. So let me just break a couple of myths in the market first before we move forward. So myth number one that I want to break is that uh, long-term investing is safe, right? People say if the stock crashes, I'll just buy it for long term. Like in the 10 years of time or 20 years of time, it's going to be safe. That's a myth. Okay. Long-term investing is safe, right? Or investing into large cap companies is safe, right? That's a myth. Okay. The reason is you have to understand how the markets really function. First of all, out of the 50 companies in the reality, okay, Nifty 50 is the top 50 companies, right? It's been there for the past 20 years also, right? Out of the top 50 companies in the past 20 years, in the 20 years, the 20 years, only 8 of them are still in Nifty 50. Okay. Rest everything has crashed. Rest everything has crashed. Cool. People talk about, you don't have to time your investments or anything. You can just buy a stock. If the company, let me just rephrase this properly. The long-term investing is safe. People say that if a company is fundamentally good, and business is really good, fundamentally good, it will always go up in price. Okay. This is a myth. There's no necessity for it to go up in price all the time. It will definitely crash at one point. Cool. The reality is 8 out of 50 people are only 8 out of 50 companies still exist in the stock market. My dad is actually one of the common examples. Like he keeps saying that, he never really analyzes stocks really much, but he invested into different companies back 20 years back and stuff, based on his corporate, friends and everything, saying that, okay, these companies are good, large cap companies, good companies. Not he hasn't made any single profit from these companies. Everything has gone in a loss, right? Yeah, he keeps talking about how XPs are the best because of that. But anyway, the first thing you have to understand is that there's a rule of 80-30, 80-50. Okay. This is how the markets actually function. It's based on 80-50, meaning that there's an 80% chance that a stock will crash by 50% from the top. Okay. There's an extension to this rule also. There's also a 50% chance that it will crash by 80% from the top. What I mean by this is that let's take almost every stock that has gone up, right? If you look at it, every stock that has gone up will definitely crash. Okay, let's have a look at IRCTC. The IRCTC was a good call out that we've just made in the bootcamp, one of the bootcamps itself. I'll tell you what I mean by this. Okay, so IRCTC, you can see this is IRCTC's chart in the past from 2020 onwards. It went up really well around 2020, 2021. Okay. It went up from here all the way till here, gave around 600% returns, or in 2021 alone, it gave around 300% returns. Big returns, right? But from the top, if you notice, it crashed by around 50%, right? By around 50%, it crashed. Meaning, realistically, from 2021, it gave only 100% returns after that crash. I'll tell you why timing the market is important here, right? So after this is the move that we caught in the bootcamp from here to here. Like it was right at the correct moment. I'll tell you how to time this anyway. So this is IRCTC's example. Any stock that has moved up by big margins to the top will definitely have a crash of 50% from the top. This is how the markets function. After this, it may or may not go up. Okay. That will realize how it is. Like there are, like, take any example. Let's say Techem over here also, right? This is, check out Techem also. Same rule, you can see how it's applying. It moved up from 2020. It moved up by, say, you can say around 200, 300% to the top. From the top, it again crashed by 50% to the bottom. Okay, we can see it crashing out at 50% to the bottom. Cool. Take, let's say, TCS or ICE, any even Infosys or whichever you look at, it's going to be the same. Okay, so this is TCS. Let's look at Infosys also. Like anything that has moved up will have a crash, right? Moved up will have a crash by 50% on top. There's an 80% chance. 80% chance means that more than 8 out of 10 times, it will actually have a crash of almost 50% from the top. Now, how is this relevant to us? Why do we care about this, right? Let's take an example of Wipro, for example. Okay, so this is Wipro, again, went up by 100, 300% to the top, crashed by around 50% to the bottom. Now it's actually going up again. It's a good time to buy into Wipro. So let me tell you why long-term investing is bad for you. Okay. Long-term investing is bad for you because people, when they see this crash, right, they will immediately, the mindset switches to saying that, but I'm holding this for long-term, like 20 years on the lane, Wipro will eventually go back up. Cool. That's everyone's mindset when people start losing money. Like it's an immediate switch. They start thinking, I'm going for long-term, right? So long-term investing is actually a myth. I'll tell you why. Okay. So think about it this way. There are two types of money in the market, smart money and dumb money. Basically, institutional money and retail money. Institutional money meaning that institutions, what they do is they believe in the style of investing that institutions also know that long-term investing is a myth. They believe in the style of momentum investing. That's what we got to be learning in today's session. Momentum investing is nothing but we got to be investing when the momentum is up and we got to exit when the momentum is out. In simple words, ride the trend and exit out of it. I'll tell you why it's important. Okay, so let's take two examples. One is the institutional investors and the normal investor. An institutional investor would do this. They would just buy the stock over here, exit around here. They'll make around 150% gain. Right. The entire move is 200, 300% and all. That's not realistic. You cannot capture the entire thing. You can capture around 100, 170% returns over here, and they will take their exit. Okay. Whereas you as a person, you would be sitting on a 300% gain at first. Okay. When the losses starts happening, you will keep holding it. That 300% gain, it will become around, say, 100% loss. I mean, 100% gain. You're still in profit itself. Earlier, you had 4 times the money. Now you only have 2 times the money, right? Like you're still in profit, but you have made a small loss in this period of time. And you're still not back up to the 300% yet. It's, let's say, 214%. So what you have to understand is that there are two costs over here. One is, first of all, your profit has gone down. That is one cost, obviously. The second is your opportunity cost. This is what people don't realize it. There's an opportunity cost, meaning this time period from 2020 to 2024, your money is stuck in this. It's not giving you any returns. 2 years of your time, the money is dead. In fact, it's giving losses for 2 years of time. Okay. So your money is stuck over there. An institutional investor would be a person where they would enter this trade. They will ride this for 2 years of time or 1 year of time. They take their exit. They make this 120% returns or 100 something percent returns. They take their exit. The next 2 years of time, they'll find some other stock which gives another 120% returns. This is the mindset of an institutional investor. This is why momentum investing, or it's essential for you to exit out of stocks. Long-term investing is a myth if it comes to direct investing. If you're directly investing into stocks, that's long-term is a myth. Long-term will work for Nifty 50 as a whole and everything through mutual funds. We'll talk about that pretty soon. But if you're a direct stock investor, long-term investing is a myth. Okay. So there's a high risk of that also, that some stocks like future retails and everything will crash. Okay, so this is the first thing I wanted to get with you guys, which is understanding that rule of 80-50 is there in the market, where the market will eventually crash by 50%. So the second myth I want to bring forward with you guys is that people talk about it's impossible to time the market. Okay, they say timing the market is impossible. Okay, although it's true that reality, it's true that you can't time the. It's true that you can't time the exact bottom. You can't time the exact bottom. Like sometimes you can, but you can't time the exact bottom consistently. Exact bottom or tops. Okay, but you can definitely time the market. Okay. What I mean by is that if you say that time the market is impossible, your entire financial industry will collapse. Meaning, starting from your HDFC Bank, ICICI Bank, they're all loans. Their main business is loans, right? But on the back end, the money that they have, everyone have trading desks. They're also traders just like you and me. They have a trading desk. Let's say they have 1,000 crore asset and 1,000 crore capital, right? It's split across hundreds of different traders. Let's say one guy is managing 10 crores, another guy is managing 20 crores. Each of these traders are trading different stocks, just like you and me, buying and selling into different stocks, right? This is their asset management wing. Basically, all banks have a trading desk and they're also traders, all financial institutions in top, right? In other words, we call these guys as institutional investors. Institutional investors, right? There are two types of them. There is DIS and FIIs, institutional investors. Okay, DIS stands for domestic institutional investors. FII stands for foreign institutional investors. Basically, people with trillions of dollars or billions of dollars or thousands of crores, right? That's what they consider as institutional investors. They enter the market with big amount of money. They push the markets up, right? Now, if you think that, okay, the institutional investors have a huge advantage and everything, not really. They're also people just like you and me analyzing the charts. They say we have level 2 data and everything. I have level 2 data access. It's nothing special. It just tells you where there's just a little bit more information on the charts, but it does not, even institutional investors don't know if the price is going to go up or price is going to go down. They're also traders just like you and me, trying to time the markets so that they can make a better return, right? Even if you look at, you may have heard about investment banks like Goldman Sachs, JP Morgan, Deutsche Bank, and everything, right? These are very straightforward with the clients. Clients come to them with $5 million, right? They tell their clients that, guys, I will trade for you. JP Morgan or Goldman Sachs says that I will trade this $5 million for you. I'll invest into different capitals across the world, different markets across the world. With this $5 million, we'll have a benchmark index. If Nifty 50 is the benchmark index, if Nifty 50 gives 10% returns, right? Anything above this is something that anyone can make. Nifty 50 returns is the normal public can make. So Goldman Sachs will trade for you. And if they make a 30% return, right? Anything above this 10%, they will have a profit sharing between them. Like 20%, the rest 20%, they'll have a profit sharing between Goldman Sachs and the client. This is how the investment banking world works. Everyone is involved in timing the markets. Even your hedge funds, mutual funds, hedge funds, asset management companies, everyone is actually involved in this industry, right? So timing the market is not impossible. If that's true, the entire financial industry would collapse. Okay, so Goldman Sachs daily trading volume is $5 billion. That's the trading capital every single day. Long-term investing is again a couple of trillions, but that's different. Cool. So this is pretty much the second myth I want to talk to you about. Let me just show you one more thing. Like there is an example of BCG that I like to give, which is, this is an example for rule of 80-50, but 80% crash in the market, right? So this was a stock which gave me around 212% return or something. This is a penny stock expansion. Okay, small cap companies with less than 10 rupees in price, that's what we call as penny stocks. Okay, when they expand, they give returns like this. From 5 rupees, it went up all the way to 120 rupees. Okay, which is, it expanded by close to 2,500%. If you ask me, can we time this? Obviously not. We cannot time this exact bottom or the exact top, but we can definitely catch this trend from here till here, which is around 250%. This is what is realistic. So we'll learn how to capture this trend over here, right? So it's a pretty good expansion. We got 250%. We can exit the stock, but you can see after this, the stock crashed by anything. Like it's down by close to 80-85% right now. It's down close to 89% right now. This is an example. So small cap companies, especially, they show the 50-80% crashes and everything. When the markets are downtrending, they will definitely have a big crash. Cool. That's pretty much about all the myths about the markets and all how the trading world really works. I think we have pretty much covered most of the things that you guys should know about the markets before we step into it. Now, finally, one last small topic is also there, which is for the beginners. There's also a question that comes up like, how does the market go up or go down, right? So this is based on demand and supply. Demand and supply. In simple words, how it works is that, buyers, demand is brought in by the buyers. When the buyers step into the market, when there's a lot of buyers, they bring in the buying pressure, as we call it. Buyers bring in the buying pressure, because of which they push the prices up. Okay. I'll give you examples to make it clear. But similarly, sellers also, the supply is brought in by the sellers. A lot of people will sell their stocks. They bring in what we call as the selling pressure, and they push the prices down. Okay. In other words, the markets are a fight between the buyers and sellers. Buyers will push the price up, sellers will push the price down. What I mean by is that, like, the buyers are also called as bulls in the market, like the animal bull, right? Bulls, because when the animal bull attacks their enemies, they push their prices. I mean, they push their enemies up. Like, they use their horn, push them up. That's why they call bulls in the market. Buyers are called bulls because they push the price up. Similarly, sellers are called bears because they push the price down. Right? Bears, because when bears attack their enemy, they use their paws, stomps on their enemies, crushes them down. That's why buyers and it's called bulls and bears. So in reality, markets are a fight between bulls versus bears. All markets are bull versus bears. If you look at, you will find a lot of statues of a bull and a bear wrestling each other. That's how they depict the financial markets. If you see Wall Street and everything, there'll be a statue of a bull and everything. That's basically how they represent the buyers and sellers. Okay. So to give you an example of how demand and supply works, let's think about it this way. Okay. How does price go up? Simple examples, like in 2003, let's say Apple introduced the first ever iPhone. First iPhone came into the picture, first ever smartphone, right? Till then, you had QWERTY keypads, the Blackberries and Nokia phones and everything, but they were not smart. Apple introduced the first ever smartphone. A lot of people loved Apple. Everyone started buying Apple shares. Demand for Apple went up. A lot of buying pressure for Apple came in. Price of Apple actually went up quite a lot, right? Similarly, if you look at the supply example, like other ways to look at it is like, how does the price go up? If you look at it from a practical scenario, let's say I'm a samosa stall vendor. Okay, I sell samosas. I have 10 samosas with me. Okay, let's say I have 10 samosas with me. Okay, I have 10 samosas with me, but there are like 50 people in the queue. Cool. A lot of people wants to buy the samosa. 50 buyers are there, or buying pressure is there. First samosa, I will sell it at 15 rupees. Okay, but then I see there's a lot of people who wants to buy it. Then I'll think, okay, what if I push it to 20 rupees? One guy will buy for 20 rupees also. What if I say I'll sell it for 30 rupees? There is so much buying pressure that one guy will buy for 30 rupees as well. What if I push for even 50 rupees? One guy will be hungry that he'll buy for 50 rupees also. In one samosa, I'll push for even 100 rupees. Okay. One guy will be so hungry that he will even buy for 100 rupees as well. In other words, as long as there's a strong buying pressure, prices will go up. Okay. When there's a lot of buyers in the market, they will keep buying and buying and buying, making the prices go up. Similarly, when there's a lot of sellers in the market, that is seller supply example, meaning this time I have competition. Okay. Like from a samosa stall example point of view, I have so many different competitors, like 10 samosas being sold by so many different sellers. Okay. A lot of hundreds of samosas are there in the market. There's only like, say, 10 people in the queue. Only 10 buyers are there. 10 people are walking around. They want to buy. So one guy will say, I'll sell my samosa for 20 rupees. Other guy will immediately say 18 rupees. One guy will say 15 rupees. Okay. So this guy will come here, buy for 15 rupees. I will say even 10 rupees. Next, I'll say 10 rupees. One guy will buy for 10 rupees. So when sellers are competing against each other, when there's a lot of selling and happening in the market, prices will crash. Okay. Prices crash. So it's a constant fight between buyers and sellers. Every minute, every second, there are buyers in the market pushing the price up. There are sellers in the market pushing the price down. So this green candlestick simply means that in this amount of time, right, at that point of time, buyers were very strong that they managed to push the price up. This red candlestick here means that at this point of time, sellers were very strong that they were pushing the price down. Every minute, imagine it's a tug of war. A tug of war between buyers and sellers. Buyers are trying to push the price up here, whereas sellers are trying to push the price down. Okay, so at any second or every minute, whoever is winning, that's where the price is going to go up or downward, right? So I'll give you some simple examples to make you understand this better. Let's take a look at Nifty 50 also. Let's take a look at pandemic example, okay? Pandemic example meaning, take a look at Nifty 50 back in 2020, okay? To understand the depth of this crash, you can see this big crash in the market, right? To understand this depth of this crash, from 2017 till 2020, price was going up. 3 years, markets went up. Okay. That entire thing crashed in hardly 1 month of time. From 7,000 to 12,000 in 3 years of time it took. From 12,000 to 7,000, it took hardly 1 month of time. This is the impact of COVID-19. As you guys can imagine, at this point of time, this is at 2020, World Health Organization declared COVID-19 as a pandemic, like worldwide crisis. So everyone started freaking out, right? Everyone started worrying about their money. They don't know what's going to happen to their capital. Everyone started selling their stocks. Everyone started selling their stocks. All the institutions started selling their stocks. Even the retailers started selling the stocks, because of which prices crashed like anything. This is the biggest crash that happened in a long time, right? So this is the impact of COVID-19. You can see when there's a lot of sellers coming in, prices will definitely crash. Okay. There's also a question that may come into your mind, which is, if everyone is selling, who is going to be buying, right? Who can buy the stock? There's something called as market makers in the market, which is institutions hired by SEBI itself. Their role is to make sure that for every sell order, there should be a buy order. It may be at a lower price and everything, but there should always be a buy order. If everyone wants to exit, there will always be an institutional buyer at any point of time. That's the role given by SEBI. SEBI is Securities Exchange Board of India, who is the regulator for Indian market. So there's always going to be a buyer and seller, right? Anyway, prices crashed like this because of the huge selling pressure that came in the market. So I have a question for you after this, which is, after this, you can see prices kept going up like crazy. From this point onwards, from April 2020 onwards, prices kept going up, right? Can you guys tell me which, I'm opening the chat right now. Right. So can you guys tell me, why did the prices go up from this point onwards? Right. Why do you think prices just kept going up after this? Earlier Nifty was at 12,000 rupees, but in 4 years of time, right now it's at 24,000 rupees, like doubled in price. Why do you think this happened? Cheaper price, 80-50% is over. Nice. Uh, Virtualization of everything, like everything is getting digitalized. Yes. Everyone started buying them back because they're cheaper now. Nice. Vaccination, political factors, psychology, 3 months pandemic. Okay. Market participants, more people got involved. That's a really nice observation. Uh, Lockdown lifted, company sales increased. Okay. Cheap and recovery from COVID. Demand is more than supply. Okay. Money started flowing. Nice. Lockdown equal to everyone started getting interest in market. That's a really good example. Uh, Stock price is less, so buyers are high. Nice. FIs and DIs started investing. Great. Nice. Economy rebuilding, new investors, government policies, because of demand and more retail investors. Nice. Cash in hand, a lot of people came to the market. Awesome. Quarantine, people made explore the stock market. Nice. Monetary stimulus, yes. Government of India put in a lot of market in the stock market. Yes. Trust on Indian market, more awareness. Nice. I think you guys got almost pretty much everything that is required, actually. History repeats itself and positive sentiments. Yes. Flow of FIS. Astrological cycles, debatable, but interesting observation. There are a couple of people who trades only based on astrology. Nifty 50 is the best 50 company. So even if it crashes, we know that it is going up. Okay. 80-50 more, trust on Modi. Okay, interesting. New people enter the market influenced by Harshad Mehta series. That's actually a really good observation. 1992 scam 1992 did trigger a lot of people to invest in the stock markets. Awesome, guys. I think you guys pretty much covered most of the things. Let me just quickly recap. What you guys just said, and let me give you an insight into how it actually works. Right. So first thing, you guys mentioned that stocks became very cheap, very valid, because stocks at this point of time, you would have noticed Instagram at this point of time, it said 80% off on Tata Motors, 50% off on HDFC Bank. Most stocks did its 50% crash at this point of time. 80-50 rule, right? That also happened over here. Like most stocks crashed by a lot of margin. And not only that, they observed that from April onwards, right? They noticed that companies were not that affected. The revenues of the company, most of the companies were not so affected. In fact, pharmaceutical companies' revenues went 3x. IT companies were actually functioning really well. Work from home turned out to be very effective as well. Cost cutting happened everywhere. Profits of many businesses actually increased quite a bit, right? So companies were not that affected also. They were actually doing pretty well, right? So first thing, as you mentioned, stocks were very cheap. Everyone started diving into the stock market. In fact, in just 1 month alone, 3 crore new demat accounts were opened in just 1 month. Usually it takes a near time for 3 crore people to join the market. In just 1 month, 3 crore people joined in. Think about it this way. In this 3 crore people, right? If they invested just 10,000 rupees each, 30,000 crore of money came into the market. As I mentioned, when there's new demand or buying pressure or money coming into the market, price will go up, right? 3 crore demat account open. That's one factor, right? And not only that, when the stock was so cheap, right? People who exited here also, they knew this is a one-time opportunity. They re-entered the market with all their money. Not only that, stocks were very cheap. They invested more and more money also into the market. More demand coming into the picture. Fixed deposit was very slow at this point of time. 3% was the fixed deposit rate, 3 to 4%. It was pointless. People removed their fixed deposit, they started investing back into the stock market. Again, more money inflow coming into the stock markets. Crazy money inflow coming into the stock markets. Markets went up quite a lot, right? And people said that, economy was doing very well, recovery from COVID and everything. But in reality, economy was bad throughout. All this phase, economy was poor. Okay, economy is always going to be poor. First thing you have to understand is that market cycle is different from the economy cycle. That is, markets are always forward facing, meaning at least 6 months into the future is what markets are predicting for. Okay, meaning if the economy is crashing right now, they're saying that okay, economy will recover in 6 months of time, so the market is going to go up. So the cycle is like this: if the economy is doing really well, right, markets would have crashed by then. There's usually a lag factor. This is the economy. Let me give it different color. Let's say this is the economy, where economy is going through recessions and it's going through lower thing is the recession. It's going through the peaks as well, right? Market is always going to be a little lagging, forward facing, meaning like this is a market cycle. It will go up way before the economy went up. It'll start crashing by the time the economy has recovered. When the time the economy is crashing, markets will be at all-time highs or will be going upwards. This is what the economy and market cycle is. There's always a gap between those two. So COVID-wise, everything situation was still very bad. There was no vaccine being found also. But even then, market keeps hitting all-time highs, right? So this triggered what is called as the bull market. That is what we are in right now, right? So there are two types of markets that we should know. There is bull markets and bear markets. Okay, there's bull markets and bear markets. Bull markets means that bull markets is when these kind of trigger happens. Bull markets is when a lot of people will start buying the stock. We are currently in a bull market right now. Bull market is where the first year return would be say 100% return. Second year would be around say 50% returns, and third year usually has a small crash of around. Third year is usually where the small crashes comes in, maybe around minus 20%, minus 25% returns. On an average, when a bull cycle starts, it lasts for 2.5 years. That's the average duration of a bull market. So if it starts, right, don't panic. It'll continue for a long time, right? So you can actually hold the stock for quite some time. Similarly, bear markets also exist. Bear markets is where the average duration for this, the usual stocks, like indices crash by like Nifty 50 and all will crash by around 20%. Stocks will usually crash by 50% or 80%. Rule of 80-50 usually happens during the bear markets. The average duration of a bear market is for 9 months of time. Okay. For 9 months, the stock may be going downtrend. That's the bear market, right? So Nifty 50 over the past from 2020, markets actually kept going up. And it went up, had a short bear market, and then again it started its next bull market cycle. We are currently still in the bull market cycle. It'll probably last till 2025. After that, the market phases should change. In other words, all market, maybe the crypto market, stock market, every market goes through a bull market phase and a bear market phase, right? So in cryptocurrencies, it follows a 4-year cycle. That is, every 4 years, there's going to be a bull market and a bear market. It just finished its bear market right now. Now it's going to a bull market, right? Every stock also has its own bull market and bear market cycles. That's what we're going to be learning, how to time these cycles in order to time our investments and make the best returns out of them. So this is bull markets and bear markets, and how we could type it. In other words, bulls always beat the bears. Okay, that's because bulls last for 2.5 years, bears only last for 9 months of time. So if you look at it from a long-term perspective, bulls will always beat the bears. Okay. This is for indices like in Nifty 50 and everything, bulls will always win. In other words, Nifty 50 will always go up in price. That's one of the strongest statements that's there in the market. Okay, so there are three ways you can go forward from here. Now you have all this knowledge. There are three options I'm putting out in front of you. Okay, either you can be a passive investor. This is a person that you can be a passive investor where you know that stock market gives you really good returns, better than any other returns. Just but you're very comfortable with your job. You don't want to put in any time into the market. You don't want to analyze any stock. You're very comfortable with your life, right? You have a working job. You're focusing on your career. You have an income coming from there, and you're just investing into the stock market. This is what a passive investor looks like, right? The best option for a purely passive investor, a person who do not look at the markets, is buy Nifty 50 index funds. Okay, I'll show you how to do that also. This is nothing but it's been proven that Nifty 50 is the safest and gives the highest return for long term. Okay, in other words, if you look at Nifty 50 in the past 20 years of time, in 2000s, Nifty 50 was just at 1,000 rupees level. Okay, it was just at 1,000 rupees. Fast forward 10 years, it's at 10,000 something. Fast forward 20 years, it's at 24,000. Fast forward another 10, 20 years, it's going to be at say 50,000 level, 100,000 levels and everything. Okay. The reason is there are multiple different reasons for why we have this logic. First, okay, first thing, literacy rate. Okay, let's start one by one. First of all, India GDP growth, as you know, it's one of the biggest GDP growths in the entire world. Every foreign institutions, FIIs are very active. That foreign institutions are very much investing into the Indian markets. Maybe Harvard Business School, or even say Abu Dhabi Investment Authority or Saudi Arabia Investment Fund. How these big governments work is that, like Saudi Arabia Investment Fund is the biggest investment fund in the entire world. Like BlackRock is the biggest institutional firm in the entire world. Like all of these firms know that India is an upcoming booming market, right? India's growth rate is really high. It's been shown that the GDP wise, right now, USA is number one, second is China, right? India is around fourth or fifth right now. But by 2070, China is going to be the number one GDP in the world. Second is going to be India. Third is going to be US, right? So India is going to be the biggest, second largest GDP in the entire world by 2070. And that's why a lot of foreign institutional investors are investing in the market. Think about it this way. We invest into stocks which are showing growth. Countries invest into different countries which are showing growth. That's how FIIs are thinking. All right. So India showing good growth rate. That means there's always going to be a big demand for India that's going to come in all the time. Not only that, every year a new 18-year-old is actually investing into the stock market, creating his demat account. New money is coming into the market from there. Not only that, the education rate of India, right? Financial literacy rate was just 2% back in 2020, 2019, everything. It's already at 20% right now. Okay. It may seem like a big number right now, but it's not. All other countries' financial literacy rate is around 60%. This will grow. India will have a 60% financial literacy rate as we go further along the line. This means that there's still 2/3 of the population which is still left to invest, because of which more demand, more buying power, more buying pressure, price will still continue to go up. This is the law of nature. So FII is investing, GDP growth, everything is actually showing India to become one of the biggest stock markets in the entire world, right? So this is why, as a purely passive investor, blindly buy into Nifty 50 index funds. Let me just show you where you can buy this also. Grow is a really good investment platform when it comes to mutual funds. You can check out Grow. You will find UTI Nifty 50 index fund. This is the largest Nifty 50 index fund. Any Nifty 50 index fund will work. I'm recommending UTI because that's the largest one in India. Okay. Basically, it's a mutual fund which will, Nifty 50, you cannot invest directly, right? So these mutual funds replicates Nifty 50, which are the top 50 companies in, like Nifty 50, whichever companies is there by whatever weightage, they replicate that same performance. They take your money into it and invest on your behalf. That's what mutual funds do, right? So this is the first step for all investors out there. Even if you're a passive investor, keep investing at least 20% or 30%. Start an SIP. SIP means systematic investment plan. Even if you're in college, start with 500 rupees SIP. This is your first step towards your financial freedom. I know that you have that mentality that I want to learn everything about the market before investing. That's not required. Getting started and cultivating the habit of investing and saving is more important. Okay. So just start with, even if it's a 500 rupees investment, just start it. If you're a working employee, at least 10 to 20% of your salary, start investing into this SIP. This is the passive investor's route. 20 years later, this is guaranteed to always go up in time. This is something that is proven over and over in time again. If you're thinking about, okay, what if real estate is a better investment, gold is a better investment? It's not. Historically, FDs gives you a return of 7.1% in the last 25 years. Gold is around 8.2%. Inflation itself is around 7.1, which is why FDs hardly beat inflation even when it comes to long term. Real estate is around 10 to 11% if you have the right location. That's a big factor. But even with your rental yields and everything, also real estate only gives around 10 to 11%, whereas Nifty 50 gives around 13 to 14%. So Nifty 50 always outbeats any other instrument out there in the market, right? So this is why, as a passive investor, just keep investing into it. There will definitely be times when Nifty 50 is crashing. Also, doesn't matter for you. Keep investing. 20 years down the lane, when you're coming to your retirement, you'll be a very happy man. You no regrets. You've worked your life and you have the best life also. And investment also, it's automated. This is what I would recommend, right? UTI Nifty 50 Index Fund. This is a passive investor who do not want to make aggressive returns or any more returns than that. The second kind of investor is your moderately passive investor. Okay, so this is a person who wants to use mutual funds to aggressively time the market. So one thing I want to make clear with you guys is that, okay, there's a lot of questions coming in, which is what about Nifty Bs? Nifty 50 ETFs are also a good option. Nifty ETFs is nothing but, you can check out Nifty Bs here. The only thing is you cannot automate this. This is why I don't recommend Nifty Bs. Like, you have to manually go into your demat account. If you have that habit of manually coming into your demat account, funding every month, then it's fine for you. But I am a person who's more lethargic in nature where it comes to investing. I want to automate things. So it will, as when it comes to mutual funds, it will automatically take my investment every month from my bank account itself. But if it's Nifty Bs, I have to manually add money into my demat account every month, then keep buying it every month on month. This also works. The expense ratio, there's a small difference, which is exit load or the expense ratio. That is, mutual funds charge you around, for Nifty 50, I think it's around 0.2% or 0.3%. It's a charge that they take. Whereas Nifty Bs also has charges, but it's around, say, 0.1 or 0.05 or something. It's lesser than your mutual funds. It's a small difference. So I don't really have an issue paying that extra one, just for that comfort of making sure that I invest every month without any fail. Right. So if you are a person, if you have that discipline to actually do it, then it's fine. Okay. There's also a question which came up, which is, didn't Grow face a lawsuit and everything? Basically, all brokers has had issues with their executions at one point of time. There's no issues as such. Like, it's just part of the stockbroker industry. Every broker has had a glitch at one point of time. So it's a normal thing in the industry. Maybe Zero, the Upstock, Zero, Grow, every broker has had an issue. So that's there. Right. So just to be clear, the returns are the same. The only difference is there's a small expense ratio difference, which is like small difference in the commission rate for these things. Whenever you're investing into mutual funds, also always go for direct investments. Okay. There'll be a lot of mutual fund brokers who try to distribute mutual funds to you. They usually charge a 2% commission for that. Like, the mutual fund itself won't be a direct plan. Direct plan means that there's no middleman getting any commission. If you're using Grow and everything, even Grow is not getting a commission out of it. It's basically a direct growth plan, meaning you're directly dealing with the mutual fund directly. There's no commission going in forward, right? So that's why direct plans are important for these. All right. So that's just pretty much it about mutual funds when it comes to moderately passive investing. Passive investing. Now, a moderately passive investor, you know that you can get more aggressive returns from mid caps and small cap funds and everything. So here is a person who would split their investments. Let's say if you have 10,000 rupees with you, right? 25% of this, I would recommend buying Nifty 50, UTI Nifty 50 mutual fund. Okay. This is basically a large cap. I'll call it index fund. Sorry. This is basically a large cap fund. There's a lot of, you will find a lot of large cap mutual funds like Tata large cap and everything. But reality is 90% of large caps will fail to beat Nifty 50 over long term. So instead of using large cap funds, it's always better to just go for Nifty 50 itself. That's why I'm recommending that. Anyway, next 25%, you can go into mid cap funds. This is something called as PGIM India Mid Cap Opportunity Fund. This is a good mutual fund when it comes to, there's a lot of things that goes behind finding the right mutual fund, like Sortino ratio, Sharpe ratio, and all these things. I'm just doing everything for you and just telling you the right ones. So this is PGIM India Mid Cap Opportunity Fund, which is pretty good. You can actually invest into this. You can see 20% in the last 5 years. Pretty good mutual fund for mid cap, right? So this is going to be a mid cap right of your portfolio. Another 25% is for your small cap. Here you can use Quant Small Cap Fund. This is the Quant Small Cap Fund you can see. Okay, just start your SIPs into all of these things. Over long term, it will give you at least 15 to 16% returns. Cool. This is quant small cap. You can see 33% returns in the past 3 years of time. Right. This is for your small cap sector stocks. Now, we still have 25% left. The rest 25%, I would recommend you invest into two different markets. One is 15%. I would recommend investing into US stocks, US companies. Okay. There is apps like InMoney and Grow also, which actually invest into this. Check out InMoney if you can. Right. This 15%. So US market is the biggest stock exchange in the entire world, right? In the Indian market is around, I think China market and Indian market are the second biggest ones, which is around $5 trillion, right? US market is $42 trillion, almost 10 times bigger. In other words, all the big companies across the world, they're all part of the US market. So US boasts about being the biggest superpower in India. I mean, superpower in the world, right? It's not just because of their military force, it's because they have the biggest stock exchange in the entire world, right? So it's almost all the big companies across the world, they are on the US stock exchange. So they give the highest returns as well, as in US market tends to give higher returns compared to the Indian markets. So what I would recommend is 15%, which means 15,500 rupees. Here, 25%, I mean, if you're using 10K capital, 2.5K is your this thing. If you're using 1 lakh, 25,000 rupees, you have to invest into large cap. Okay. Hope you got the idea. So what you can do is this 5% US stocks, either you can invest all into just this one, that is Vanguard S&P 500 ETF. S&P 500, just like Nifty 50, S&P 500 is the top 500 companies in the US market. That's the main market index for US market, right? So that's the safe investing itself. Just like Nifty 50, we're investing into the Nifty 50 of US market. Either put all 15% into just that, but if you want to be a little more aggressive or if you want to make higher returns, another 5%, you can invest into Invesco Global Clean Energy ETFs. I'll give you these notes later also for you guys to just look through these and find all of them. But there's Global Clean Energy. As you know, everything around the world is shifting towards green energy, right? Green energy meaning clean energy, right? Solar energy, wind energy, and everything. All the top solar, wind energy companies across the world, wherever is the big ones, they're all listed in the US market. And this company, Invesco Global Clean Energy, they invest into these top companies across the world, right? So that's there. Similarly, there's one more thing, which is iShares Semiconductors ETF. Okay. This is your semiconductors. As you know, the entire technologies of the future relies on semiconductors, and this particular iShares basically invests into all the top semiconductor ETFs of the world. So that's where all the money is. So just keep investing into this. You're pretty much sorted for life. Rest 10%, I would recommend you have a crypto portfolio. I'll give you the entire crypto portfolio for this current bull run towards the end of the session. But on a general note, you can invest into, say, Bitcoin is kind of outdated right now because it doesn't give much returns. But Ethereum, Mana, Sand, uh, these are just the Matic, Binance. All of these are pretty good coins just to start off investing with, right? Large cap coins, safe investing. So this is a good portfolio for moderately passive investor. Crypto portfolio for the main one, I'll give it towards the end of the session, which is the entire thing. Okay, cool, guys. I think we have covered up everything you guys need to as a passive investor or a moderately passive investor. Now we have to get into active investing, right? Here's the main part of the session. Just a quick energy check, guys. Are you guys still here with me? Like, still okay? Like, all good? Can we still go forward? Like, energy check. Can I get some fire on the chat? All good? Yes. All good? Yes, yes, yes. Okay. Let's go. Okay. Love the energy, guys. I saw some fires also. Thank you. All right. Great, guys. Lovely. Empty. Sweet. Okay. Yes. Waiting for the strategy. Okay. Amazing. Yes. Hell yeah. Okay. Cool. Very interesting. Cool. Thanks, guys. I see a lot of rockets and fires now. Crazy. Okay. Great, guys. Now let's get into the final section. All good. Carry on. Thanks, guys. Thanks all for the lovely reviews. Like notes would be notes would be given out towards the end of the bootcamp. Yeah. So by tomorrow, I'll give you all the notes. Cool, guys. So let's start with the final part of the session, which is active investing. Okay. So here is where we're going to cover up how to active investing. We call it positional trading or momentum investing. It's all coming under the same criteria. Okay. So we're going to learn how to time the markets to actually get the best returns. Momentum investing. Cool. So let's go forward with the last part. So there are two types of analysis that people do. Okay. Two types of analysis. One is your fundamental analysis and technical analysis. Back in the early days, only fundamentals existed. Technicals did not exist. Fundamentals meaning that you're looking through the company's balance sheet, the profit and earnings, and all these things, right? Nowadays, it has become much more simple in nature. People still think that you have to go through the balance sheet and everything. It's not required. Everything has become digital and it's much more easier now. So let me walk you through fundamental analysis, the easiest way to do fundamental analysis. So fundamental analysis usually follows a three-step process. It's a top-down approach. In top-down approach, we have the first thing that we look out for is a theme. Then we have sectors under that theme. Then we have to find stocks under that theme. So stocks under that sector. This is the top-down approach for fundamental analysis. Okay. So it's simple. Let's wait. Let me just open the chat one more time. Okay. So yeah, I have a question for you guys, which is first of all, yeah, recordings would be given, notes would be given, no problem. Now, the question for you guys is that uh, imagine that it is 2035, 10 years down the lane. Which all sectors or what are the technologies of the future or what are the things of the future? What do you see as growth around you? Okay. Different things around the future. I see a lot of AI, EV, automobiles, pharmaceutical, climate. Nice. That's a really good theme. Semiconductors, yes, definitely. Clean energy, green energy, infrastructure. In India, Indian government is actually spending quite a lot on infrastructure. So yes, infrastructure is going to be really cool. Electric vehicles, solar, AI, insurance, yes. That's a really good pick though. Like insurance is actually an underdeveloped sector in India. It's going to become developed in the future. Financials, medical, nice. Medical is also a good theme because we've been spending trillions of dollars on cancer research over the past 20, 30 years. We're finally going to get a cure for cancer within the next 10 years. Defense sector, yes. India is one of the second largest importer of defense goods. They want to stop importing completely. That means so much money is going to come into the defense sector. That's really good. Renewables, electric cars, defense, pharmaceutical, yes. Digitalization, agriculture, yes. We have agri-tech coming in. Agriculture is coming in with hydroponics farming. Agri-tech technology is coming in with agriculture, which is really cool. Automation is coming in the sectors. Let me see. Water resource management. That's really cool, right? So when it comes to waste management system, water resource management, all of these are themes that's actually coming up pretty big in the future itself. Someone mentioned climate also, right? As you know, government of India there's a lot of themes that government of India is actually supporting quite a lot. One of them is climate. Like if you want to build a startup around climate change and all these things, they will actually fund you quite a lot. Uh, so a lot of the technologies, yes, drones, nanomaterial, that's really cool. Sustainable development, yes. So graphic cards, yes. Uh, Hydrogen, yes. Defense technology, logistics, nuclear energy, clean energy, crazy. I think you guys covered up a lot of these themes. Okay, space also, yes. Space tourism is actually coming up. 10 years down the lane, it's definitely going to be there. Cybersecurity is actually picking up. That's really cool. Okay, fintech is also actually picking up quite well. Export is going to increase quite a lot. All right, so I think you guys get the picture. A lot of really cool themes over here. Okay, I think there's a lot of on the chat. Okay, logistics, cool. Blockchain, yeah. So just want to get you guys on the right path. So whatever you guys mentioned, all of these themes may be maybe say semiconductors or say solar, or all of these are really good themes, right? Green energy, waste management systems, all of these are really good themes. Farming, all of these are themes of the future. No, there's no doubt, right? So think about investing in this way, which is wherever the government is investing money in, or wherever money inflow is coming in as a sector wise, right? So whichever sectors are booming up in the future, just put your money behind it. Your money will also grow. Reality is it's not just one sector which will give you huge gains. All these themes will actually make you money. So think about investing in a different way now, which is figure out which themes do you want to support. Like you as a person, investing is nothing but you're investing into companies so that that company can grow. Which all visions of companies do you support? If you support solar energy, if you want to promote climate change and everything, support those company stocks, right? So if you want to go into farming or waste management systems, that's what I'm a big fan of, right? So I invest into companies like that. So figure out what themes that you want to follow and put your money behind those things. So all of these themes will work. Definitely, that's a first step. Now, once you have a first step, that is green energy theme, for example, figure out what sectors comes under green energy. There are solar sector, there is wind energy sector, there is hydrogen, tidal, All of these different companies are there. Now you have to figure out different stocks. So always the step is always the same, right? We just go to Google or Chat GPT. We say top solar stocks in India. Okay. First of all, do not ever buy into any company just because you read something online. Okay, you have to do your own research. So let me show you how to do this. So you can see Adani Green, Tata Power, all these are good companies, right? The next step I want you guys to do is make sure you go to trendline.com. Here's the next website. I'll just put it on your chat, on your notes. Okay. So this is a really cool website when it comes to analyzing fundamentals. It's the simplest way to do your fundamentals. For example, we saw Borosil Renewables. They manufacture the glass for, they had the monopoly in glass production for all solar companies, right? So you can see right now, Borosil Renewables. Oops, 1 second. All right, so you'll find 3 different scores on this. You'll find the durability score, valuation score, and the momentum score. This is nothing but your fundamental analysis. Okay. In other words, basically, trendline.com is doing all the research for you and telling you how the fundamentals looks like. Okay. So let's look at what these means. DVM, durability, momentum, and valuation. DVM. Durability stands for how durable the company is. In other words, the financial strength of the company. Is the company making good profits? Is the earnings of the company increasing every year? That's durability, right? If the financial strength of the company is increasing, that's how you can say that durability is good. If it is green, it's really good. If it's red, stay away from that stock. Orange means it's medium strength, that's fine. That's durability in short. Your business model evaluation, ROE, ROC, everything comes under durability score. Valuation is nothing but if the stock is undervalued or overvalued. So there is something called as a market value of a company. This is nothing but the stock price, market's price. Then there is the book value of a company or the real value of a company. Okay. So depending on the total, it's nothing but it's a total assets minus total liabilities. Okay. Simply put, if the company has a lot of inventory, if the company has a lot of machinery, a lot of real estate, a lot of land, a lot of resources, right? So based on that, there is a real value for a company. There is a particular stock price that the company should be valued at, or the price of the company should be something or the other, right? So this is what we call as the book value of a company. So usually the market value and book value are very different. Market value is the stock price, right? So let's say the stock price is 100 rupees per share, whereas as per the books, as per the real value of the company, fundamentals of the company, it should be book, let's say book value is say 50 rupees per share. So this is where this kind of thing is what we call as overvalued companies. The company is currently overvalued. The market price is more than the real price of the company. Similarly, there will be situations where it might be rupees 50 per share is the market value. I'll call it MB. Okay. And whereas the book value would be say 100 rupees per share. Book value would be say 100 rupees per share. This is what we call as undervalued companies. Okay. So this style of investing is what we call as value investing. This is what Warren Buffett and Peter Lynch and everyone talks about. Value investing is nothing but if you believe that the company, they believe that if a company is worth XYZ, if the company is worth XYZ right now, or let's say 50 rupees per share right now, if the book value is 100 rupees per share, eventually the market will realize the real value of the company. It will eventually realize the real value of a company. This 50 rupees will eventually go up to 100 rupees. That's what undervalued investing talks about. In simple words, invest into undervalued companies. It's hard to go wrong, right? So if the valuation is very red in color, these are overvalued companies. Stay away from them for now. Like when the stock price crashes and everything, it will eventually become green over time. But right now is not a good time to buy. That's what it says. It's not saying it's a bad company, just saying that it's not the best stock price to buy it right now. Wait for it to be undervalued. That's what it says. Finally, last one is momentum score. This basically tells if the stock is moving up right now or not. Is it moving up right now or not? It's not that important for us right now because we'll be looking at that in the technical side. For us, it's simple. All we have to look at is durability and valuation. If either of these are red, run away from that stock. Don't invest into that stock. Okay. So if you look at solar companies, let's say we saw Tata Power, right? If you look at Tata Power, let's see what this is, right? So you can see Tata Power is a mid-range performer, or you can see durability is really good. Valuation is getting expensive. It's mid valuation. It used to be completely green, but now it became red. I mean, orange now. This is still fine. You can still invest into the stock. Okay. In short, invest only into companies where it's either orange or green in color in durability and valuation score. So if you look at any company, let's say Wattec, Wabag, this is a water waste management company, which I like. You can see it's getting expensive now. It used to be good valuation, but now it's getting mid valuation. The stock is price is going up, but yeah, strong durability, strong valuation and everything. But yeah, still good. So if you look at say companies like HDFC Bank, right? You can see the durability score of HDFC Bank is low financial strength. It's 35, right? Even though HDFC Bank, you may look at it like a really cool company, durability is actually kind of bad right now. Not a good time to invest. Cool. So whichever stock you invest from now on, before you do it, a small simple check can do a big margin for you. Like this simple check itself can actually can work wonders for you, right? So if you want to be a active investor, you can just do fundamentals alone and forget about it. Just only invest into companies which are showing green all around. That's enough. Even that actually works as a fundamental investor. You cannot go wrong over there. That works itself. But let's take one step further. Let's even make it more accurate, or let's have the best returns possible, right? So this is where we bring in technicals into the picture. Okay. Technical analysis is nothing but fundamentals tells you how good the company is, but it does not tell you when should I buy the stock. If I buy it, what should be my risk? What should be my target? None of that is being taught. So technicals basically defines your trade in the sense, tells you the right entry, your exit, your risk. That's what technical analysis is all about. This is the art of reading the charts. Art of reading the chart. Okay. So technically, if you ask me what is more important, fundamentals or technicals are actually more important than fundamentals. Like earlier, fundamentals is basically your research part, right? If you look at from a hedge fund point of view, like a trading firm point of view, right? What they do is there's a research team who does the fundamentals. They'll see that okay, the steel prices in China is increasing. That means price of steel stocks should go up, right? This they will tell to the technical traders. The traders will look at this. They'll analyze the stock chart. Then they'll analyze what is the right entry point I should buy it. And they'll keep entering the stock at the next best entry points and entry points. They'll keep loading up the stock. That's what traders do. Technicals is always the most important thing. Research is the secondary thing. If you just buy a lot of investors, long-term investors, they only do their research and just go for it. That's also fine. But technicals is not so hard. Let's see how to do technicals. Cool. So let's start with the chart side of things now. Let's have a look at okay, so let's have a look at technicals. We already saw what candlesticks are. I'll just quickly brief you through what candlesticks in very short. Like we saw candlesticks earlier also, which is if buyers are more, it's a green candlestick. If sellers are more, it's a red candlestick. Okay. There is 4 components to a candlestick: open, high, low, and the close. It simply says that there are different time frames. We have to learn about time frames first. Time frame is nothing but there are different time frames. There's 5 minutes time frame, 10 minutes, 15 minutes, and everything. Let me just show you on the chart for better clarity. Okay, so let's have a look at, let's take a look at some stocks instead. Okay, let's look at its Tata Steel, for example. So this is the time frame segment. Okay, I'm using tradingview.com because it's in this same tradingview.com. I can track across all different markets like crypto market, forex market, everything. Even if you're on a DMAT platform, also you can find the same thing. If you're using say Ultra Semco on HDFs on this thing, you can find the time frames over here. You can see 5 minutes, 15 minutes, 30 minutes, etc. Right. So let me just quickly walk you through what time frames are. So there are different time frames for different style of traders. Let's see what I mean by that. I'm going to go to the 5 minutes time frame now. This is Tata Steel's chart yesterday on Friday, on 5th July. Market opened at 9:15 a.m., then 9:20, 9:25, 9:30, 9:35. Every 5 minutes, one candlestick is appearing. 5 minutes time frame means that every 5 minutes, one candlestick is appearing. In other words, every 5 minutes, what is happening to the stock price is being recorded by one candlestick. Every 5 minutes. If I say, let's record the same thing on a 30 minutes time frame. In this case, every 30 minutes, one candlestick is appearing. This is at 9:15, market opened. Then 9:45, 10:15, 10:45. Every 30 minutes, one candlestick is appearing and it's tracking the price point. It's tracking how much the price is going up or price is going down. Okay, that's 30 minutes time frame. If you look at say a 1 day time frame or say 4 hours time frame, now the chart is very small. It's just two candlesticks, 9:15 first candlestick, then 1:15 next candlestick. That's it. If I look at the same thing on a 1 day time frame, every day, Friday, what happened to the stock price? It's being recorded by this candlestick. Thursday, Wednesday, Tuesday, etc. Every day, what's happened to the stock price is being recorded. We can even go for 1 week. That is, last week, what happened to the stock price? This is Tata Steel last week. Before that, it was this. Before that, it was that. So this is the 1 week time frame. Every week on week, what is happening to the stock price is being recorded by each candlestick. Now, why is this important? How is this relevant to us? Okay. So based on the time frames, we have different styles of traders. Okay. We have three different styles of traders, meaning we have the day traders, swing traders, and positional traders. Okay. We have the day traders, positional traders, and the swing traders. They'll enter. So we'll start with day trading. They'll enter and exit on the same day. I'll just simplify this. On the easy way to remember this is like whichever platform you're using, no, you'll see this line separating each of this. Okay. This line means that these timeframes are used by day traders. Okay. Day traders care about what happens every day. They'll enter and exit on the same day itself. They want to track what happens every single day, every single minute. They don't care much about the other trends. Whereas second style of trading is swing traders. Swing traders are people, working professionals especially, try to do swings where they will buy and hold stocks for say 1 week to 2 week of time. They'll buy today, they'll exit after 2 weeks of time. That's what swing trading is. Okay, that's what swing traders are. They'll buy today, exit after 2 weeks of time. So they will use 1 hour or 4 hours time frame. These time frames are used by swing traders. The 1 day, 1 week, and 1 month, these are used by positional traders or long-term investors, right? Positional traders or long-term investors, they'll hold the stock for 6 months minimum. They'll hold the stocks up to say 2 years of time, or sometimes even 5 years of time. Okay. 6 months to 2 years of time is your positional traders. We are going to be learning about positional trading first, right? So in simple words, as a positional trader, I don't care about if I'm looking at the stock for long term. If I want to buy into Ultra Semco for long term, I don't care about what happens every 5 minutes in the market. I only care about the long term trend. That's why I use 1 day time frame or 1 week time frame, because I'm going to hold this anyway for 1 year of time and stuff. Shorter time frame doesn't matter to me. Similarly, a swing trader, they'll be using 1 hour time frame. Like the chart will be very different. You saw the chart is very different now, right? They'll be caring about, okay, what's going to happen for the next 1 week of time. That's where swing traders will come in, right? So depending on what kind of a trading you want, you'll be switching between these style of traders, right? So if you're going for intraday, you'll be using say 15 minutes time frame and be looking at it. So if you notice, the chart will be very different in each of these time frames. The chart is very different, meaning whatever style of trading you want, the same strategy itself, if you just change the time frame, you can use it for swing trading. You can change the time frame, you can use it for intraday trading or positional trading. Okay, so we're just learning how to analyze the charts or the time frames properly first. Cool. So now we know time frames and we know the different style of traders. We'll be focusing on positional trading first. That's a long-term investment. Okay, so we also saw the candlesticks. Just to make the candlesticks a little more, just to understand the components of the candlesticks clearly. Let's say the time frame is 5 minutes, which means every 5 minutes one candlestick will open. So let's say the time is 9:45. Okay, a new candlestick is about to open. At 9:45, whatever the stock price is, that is called as the open of the candlestick. When a new candlestick opens, what is the opening price? Price at that point is the opening price. Next 5 minutes of time, buyers are pushing it up, sellers are pushing it down. The lowest price it goes down to, that's the low of the candlestick. And buyers will again push the price up. Highest price it goes up to, that's the high of the candlestick. And that at the close is nothing but after 5 minutes of time, at 9:50, whatever is the price at which it closes, that's the close of the candlestick. These are the major 4 components of a candlestick. This is good enough for now. Now let's see how to use these on the charts. How can we actually take trades based on this, and what is the logic behind all these things? So we got to learn something called as market structures first. Okay. First thing we got to know is that when we look at a chart, now we're going to start with positional trading. Yeah. So we'll be using the 1 week time frame first. Okay. We're going into active investing or momentum investing, which is nothing but positional trading. So for positional trading, the time frame that we'll be using is 1 week time frame or 1 day time frame. Mainly 1 week is what we use for analysis. Okay. 1 day we may switch down to analysis sometimes, or for entries and everything we may use 1 day. Anyway, so 1 week is mainly for our analysis for long term. So when we look at a stock chart, right, there are a couple of things that we can understand from a chart. First thing is that the trend of the chart. Trend of the chart means that, like you can see, like in normal, if you just look at the eyes from normal point, from this point till this point, price is going up. Okay. This is what we call as an uptrend. This is the simple definition of it. There's an uptrend. Price was going up. We call that an uptrend. Okay. Similarly, at one point of time, the price was going downwards also, right? Let's say, okay, you can see from 2018 to 2020, you can see the price was actually going downwards. This is what we call as a downtrend. Price was going downwards. This is what we call as a downtrend. Downtrend. Okay. Downtrend. And finally, there are also times in which price may go sideways. You can see, so it's a market is always going in cycles. Right? It's going uptrend, then it goes downtrend, goes uptrend, goes downtrend. Okay. Now you can see the cycles of the market, right? Uptrend and downtrend. We'll learn how to define this clearly and how to time this also, right? At some points of time, you will see that market is going sideways also. Like you can just draw a box around it. It goes sideways. It's going sideways here, right? That's called as a side trend. These are the three types of trends in the market. It can either go upwards, downwards, or side trending. How to define this, how to take trades based on this, why is this important? Let's get into that now. So let's just look at the schematics for a while. Before we'll dive into the chart properly a little in say 5 minutes of time. But before then, let's just have a look at what trends actually mean. So first thing, when the price goes up from point A to point B, if you have noticed by now, it doesn't just straight up go upwards. It doesn't do that. Instead, what it does is it goes up, comes down, goes up, comes down, goes up, comes down. In other words, it swings around. It swings. Each of this is what we call as a swing. A swing is nothing but green candlesticks will go up till one point, and then red candlesticks starts to come in. Then red candlesticks will come in. Okay, red. And at one point, red will also stop, and greens will again come back in the picture. Okay, this is what a swing is: a set of red and green candlesticks. So each of this is what we call as a swing. Okay, this highest point over here is what we call as a swing high or a high. Okay, let's call it SH or a swing high. This red candlesticks, the lowest point it comes down to, that's your swing low or swing low. Let's call it swing low. Okay. In other words, if you look at a trend, let's look at this part, right? This is what a swing. This is what a swing is. Highest point it went up to, that's your swing high. Lowest point it went down to, that's your swing low. Then again, it forms the next swing. It formed a high. It formed a low. Next one also formed a high, then formed a low. In this scenario, you can see it's forming higher highs, higher highs. Compared to the previous high, it was at a higher high. Compared to the previous low, it's at a higher low. It keeps forming higher highs and higher lows. This is what is characterized as an uptrend. An uptrend is nothing but if the price is creating higher highs and higher lows, we call that as an uptrend. Similarly, there's a downtrend as well. Downtrend is where it keeps forming lower. This is a low. This is the high. This is the next low. This is the next high. This is the next low, next high. It keeps forming lower highs and lower lows, right? That's the characteristics of a downtrend. Again, how is it important for us? Why is it valid? We'll get into that. So this is lower highs and lower lows. This is the literal market definition of an uptrending structure and a downtrending structure. Finally, side trend is also there, where all the highs and all the lows are in one single area or contained in a single area. Consolidation. That's higher highs. That's all your highs and all the lows in one single category. Okay, that's your side trending market, right? Whenever you see things like this and all in the market, right? Like some scratches and all these things like going sideways, if you can just draw a box around it, that's a side trending market. So the idea is very simple, guys. The idea is very simple. Positional momentum investing, what we believe in is that this is what is used by hedge funds across the world for long-term investing. What this belief is that the principle is that, let's start with the principle. Principle basically says that cut your losers short and let your winners run. This is the principle behind it. We'll deep dive into it. The idea is simple. There are a couple of rules that you have to follow. The first and most important rule is that you only invest in confirmed uptrends. Okay, if the stock is confirmed uptrend, I'll tell you what confirmed uptrend is. Only then you invest. Never invest into a downtrend. If a stock is downtrending, do not even think about investing into it. Just forget about that stock completely. Okay. If a stock is downtrending, run away from that stock. Similarly, you cannot invest in the side trends also. Side trends are also risky. Side trends, you may choose to invest it if it's a right one, but side trends are also risky. Mainly, we just invest into confirmed uptrends. We'll talk about what confirmed uptrends are now. Okay. So this is very simple but very effective. Uh, Let me just show you what an uptrend looks like. Okay, we'll start with the schematics, then we'll look into chart examples to give you a perfect idea. So this is what an uptrend looks like. Okay, so I mentioned confirmed uptrends here. So if we form like this is the first high, first low. From compared to this previous high, it made a higher high. That's a good sign. It forms a higher low. That is a good sign. What we're looking for is a three-layer confirmation. If it starts forming, if it starts going above this previous high, this is what we call as a breakout point. Let's call that as a breakout. Okay, a breakout meaning that the minute it goes above this, it's starting to form a higher high. Okay, a third higher high is being formed. That is what we call as a three confirmed uptrend. We follow a three-layer confirmation either for confirmed uptrends or downtrends is the same. A three-layer confirmation is what we follow. We need a higher high, we need a higher low, and a higher high. If this happens, we call that as a confirmed uptrend. From this point onwards, you can buy into the stock. Okay, you have two entry points. You have two entry points. One is you can buy the break. The second one is buy the dip. So how do you define the dip? How do you define the break? What I mean by this is that the idea is very simple. Uh, when this happens itself, here itself, you can buy the stock if you want. This is your first entry point. You can buy it right away there. That is one entry point for you. Okay, you're buying the entry point there itself, or this is what is called as buying the breakout or buying the breakout. You can buy over there. But once the price comes back down again, this is the higher low formation, right? This is called as buying the dip. You can buy at these points as well. This is buying the dip. Okay. So buying the dip is a half-baked knowledge that is on Instagram and social media. You'll find every time something crashes, right? People talk about buying the dip. That's half knowledge. Do not ever buy the dip if it's in a downtrend. Like I remember crypto was crashing and people kept saying buy the dip, it's gonna keep going up and everything. Crypto was in a confirmed downtrend. Bad time to buy the dip. That's suicidal move. Every time you buy the dip, right? It'll go up for some time, then crash again. Buy the dip again, crash again. This is something that Einstein did actually, in fact. Fun fact, uh, I'm not sure if it's Einstein or Newton. Newton wiped out 50% of his wealth because of the stock market. Right. So his idea was that just a quick fun story, I'll just let you guys know. Like Newton invested into this trading company which exported slaves from Africa to US. At that time, it was legal. And like he bought a stock at say, let's say $10 and stuff. Price went up to $20. He sold the stock. He was very happy with the returns and everything. Like he was very excited, right? But then when he looked at it, it kept going further up to $80 or something. So he started feeling FOMO or fear of missing out or regret and everything, right? Then he started buying more at this point of time. Okay. He started buying more at this point of time, put a lot of his wealth over there. Price started crashing. Every time it started crashing, he bought more and more. He started buying the dips, expecting the price to rise up and everything, right? So Newton is a good example of how you should not be investing in the markets. When the stocks are downtrending, you should never invest in those stocks, right? And this is how he wiped out his entire wealth. During an uptrend, you can buy more and more every time the stock breaks high or buy the dip. In other words, if a uptrend is started or if it's confirmed, anytime it goes above the next high, like here, this is also the next break. You can buy here also, no problem, right? You can buy when the price comes down here also, you can buy more, no problem. If it goes above this high here also, you can buy more. That's fine. As long as the stock is uptrending, you can keep buying the stock. Okay, now the question might that come up is that, but how can we predict when the stock is like to reverse or how long is the uptrend going to last for? Okay, there's something called as time cycles in the market, which is if an uptrending starts on a weekly time frame I'm talking about, in the long term, if an uptrend starts, if it starts uptrending, right, the cycles for it is that it'll last for at least 6 months of time. Or if it goes above 6 months, it's going to continue towards 2 year cycle. If it uptrends for more than 2 years of time, it's going to uptrend for 5 years of time, which is kind of rare. The rarest is a 10-year cycle. If it uptrends even after that, it can uptrend for 10 years, but that's not going to happen to many stocks. I've only seen one or two stocks which has had a 10-year cycle. Like 5 years and 10 years are a very rare cycle, but 6 months to 2 years is the most common cycle, right? Similarly, in downtrend also, it's a different time cycle. I'll tell you about that. Let's just finish this off. So the idea is very simple. Anytime a price breaks above a particular stock like this, okay, anytime the price breaks like this, if it's uptrend already, right, you're very late to the market. You're only looking at the stock at this point of time. You're looking at the stock only at this point of time. Let's forget about this side of the market. But even if you see that, okay, the stock has been uptrending for the past 6 months of time or something, you can still buy into the stock. These are your entry points. Anytime the high breaks, you can buy it. Anytime it reaches a dip, you can buy there also. Either buy the break or buy the dip. Once we see the practical charts, you'll have a better idea. Also, when we talk about when should we exit, or what would be a good exit point, we can wait for a trend reversal. Okay, trend reversal meaning, check this out. Uh, okay, trend reversal, or there's a 3-layer confirmation that you follow for downtrends also. If it forms a lower high, lower low, and lower high, this is what we call as a confirmed downtrend. The exact opposite. Once a stock becomes confirmed downtrend, all the institutions who had thousands of crores into the stock, right? Everyone will start exiting their stock. A huge selling pressure would come in. If you look at, I'll show you more examples, but when you look at stocks which has formed this lower high, lower low, lower high, from this point onwards, right, all stocks will have a huge crash. Huge crash. That's the general no. That's always the nature of these kind of stocks, right? I'll show you when you look at the charts, you will have a better idea on this. So the idea is simple. After last high, right, if it starts forming a lower high, that's your first warning sign. You don't have to exit right away, it's still fine. But if it starts forming a lower low and a lower high, then you should run away from that stock. Like, it's time for you to just exit and run from that stock, because it's going to be hell for you after that. Okay, so that's your main trend change. Similarly, you will also find stocks which have been downtrending for a long time. This is the case of IRCTC that we called out in the bootcamp earlier. Like, the stock has been downtrending for a long time. These are your best picks. Okay, these are the kind of stocks that you should be looking out for. So here in this case, you can see this was a high, this was a higher low. It started forming a higher high. Okay, if it forms one more higher low, that's a good time to start buying into the stock. Okay, or you can either, once this happens, right, and downtrend is over, this is the starting of an uptrend. In other words, after the last low, let's say this is the last high and low, if it starts forming a higher high, a higher low, higher high, 3 layers, we need 3 layers of confirmation: a higher high, a higher low, and a higher high. This is the start of an uptrend. You can buy at this point. That's one option. Or anytime it dips, you can buy more there. Or anytime it breaks also, you can buy more there also. This is how you buy during uptrends. Okay. I think you'll have better clarity when we see the charts properly. Let's have a look at the cryptocurrency industry right now, because I told you that crypto is in a bull run. Let's just look back in time. Let's see how this actually comes into the picture. Let's see BTC, Bitcoin, US dollar. From where do we have the chart data? Okay, so this is Bitcoin. So this is Bitcoin's data from 2015 onwards. There was a bull market and bear market before this also, but let's not look at that. Okay, so let's just start our trend analysis first. First thing we need on trading, this is only for tradingview.com. It's not there on other platforms. Just go to this indicator tab, type in swing high, swing low. Okay. The other platforms, like, ideally, I define the swing high low is you have to train your eyes for it. Like, you should be able to say that. Green candlesticks went up, that's the high. Red candlesticks went down, that's the low. But this tradingview.com has this indicator. I'll just type it in one more time: swing high, low, support resistance indicator by Pattern Smart. Basically, this shows you all the swing highs and lows point, so that most of the highs and lows are being covered in this itself. So it makes your trading life much more easier. Cool. So just have a look at this. So this red line simply means that these are the swing highs. These are the swing highs. These are the swing lows. Okay. Check out this. This is in 2015. Bitcoin at this point of time, from this point onwards, it made a higher high. Okay. And here it made a higher low as well. Cool. Higher high and higher low. And after this, This made a higher high over here. This is the starting of the uptrend for the 2015 cycle. A higher high was formed on Bitcoin here. This is the start of the uptrend. You can buy the stock or buy Bitcoin at this point of time. That's your best entry. Okay. After that, you can see Bitcoin went up, formed the next higher high. Okay. And it came down also. You can see this blue line, right? These are your higher lows. This is buying the dip. So if you had missed this entry over here, it's fine. You could have bought more on this dip. Buy at this dip. Okay. It's an uptrend. It's confirmed uptrend already. Now you have the option to buy at every break and buy at every dip. So here in this blue line comes in, you can buy more. And their next break also came in. You can buy more here also if you want. Even if you're late, also it's fine. You can buy at this point. And you can see price went up again, price crashed again, higher low. Now see how it's going, right? So our entry, let's say it was at $500, right? This was the starting of the uptrend. We bought at $500. This is for Bitcoin. And again, higher high, higher low formations, more and more higher high. All of these breaks and all of these highs, you can buy it. Now you can see Bitcoin is just going, you know what, we'll just replay the chart. Right. More higher highs, more higher lows. This is how it looks on the live charts. Higher high formation at low. That's the next one. Uh, there. Now it's going. This is the bull run in the markets. Bull run has started. And again, higher high, higher low. Each of these dips, you can buy more. There. Again, it's going further up. Damn. You can see this was the 2015 bull run in the Bitcoin market. Right. So you can see the kind of gains that were just came in. That's at 18,000 level. Right here is the trend reversal that just happened. It doesn't pick up on the indicator here, but let's just look at the same thing at the 1 day time frame. You can see lower highs being formed, lower lows being formed. Okay, like this was the last high, then lower high, like multiple lower highs along the same line, then lower low, lower high. Just follow the red lines, yeah. I'm using the 1 day time frame because on 1 week we couldn't see the clear lines over there. That's why I'm putting 1 day. You can see lower high, lower low, lower high formation, confirmed downtrend. This is our exit at 12,000. This particular trade we'll look through these examples one more time. Even if it goes over your head, it's fine. We'll have multiple examples of the same. But just check this out. We entered at 500. Our exit is around 12,000 when the trend changed over here. Okay, so at 12,000, trend actually reversed. 500 to 12,000, that's around, I don't know, 20x or something. That's there. And then after that, you can see at 12,000, this is the situation. Let's go back. Lower high formation, this is a downtrend. Crypto it's a downtrending formation. We don't enter. Let's go back to the 1 week time frame. Now, when is the next best time to enter is what we have to look out for. Okay, the stock is in a downtrend. We are already out of the stock. I mean, out of this coin. Let's keep following it. Now, if you want to enter this, okay, let me just make it clear. If this downtrending cycle has started, if I want to enter this, I need one higher high, higher low, and higher high. If this comes in, I can enter the stock. Till then, I can't do anything. Okay. Let's keep analyzing this in lower highs and lower lows. Great. So you can see downtrend still is crashing quite a lot. When do we start investing again? Cool. Here it formed, check this out. This was the last high. It's forming a higher high right now. Formation is not done yet. Okay. Let it wait. Okay. So it formed a higher high now, but we can't enter the stock. Okay. We need a 3-layer confirmation if you want to enter this. As you can see, it did not give a 3-layer confirmation yet, and it's probably going downtrend. It's forming lower highs and everything. Cancelled. There's no uptrend formation. Okay, it formed a lower high after that. No uptrending formation. Cool. Now let's see when does it form the uptrend. Again, lower highs. Okay, it's about to break this high. Cool. It did a higher high formation. Again, no uptrend as of now. No trade. It did a higher high as you can see. Okay. Okay, there. Stop. Cool. Here is our next entry for crypto market bull run. Okay. You can see this was the earlier highs. It made a higher high. It made a higher low. Next bull market started here at 12,000. This is the starting of the next uptrend, a higher high formation. This is where you buy the stock. From this point onwards, you can either buy the break or buy the dip. Two options for you. Okay. So let's just follow this cycle. This is what happened. So you can see, yeah, around 12,000 we would have entered, and nice. It's up 30,000, 36,000 already. And yeah, all of these are high breaks. Indicator is not picking up the high break properly. Like this technically a swing high, could have entered. But yeah, around 66,000, this is where the reversal started coming in. Now, this is actually a reversal from here itself, but let's see. Yeah, this indicator is not picking up all of these, but all of these are lower highs and lower lows. I think if you switch to the 1 day time frame, you can see it clearly here. Yeah, see, you can see it's a lower low, lower high, lower low formations and everything. It's basically in a downtrend. We would have exited around here itself. So from 12,000 to 50,000 would have been this bull run, which is also done. Uh, we'll analyze stocks also pretty soon. Let me just quickly finish this off. This is basically the last crypto bull run. This was in 2022, and then it's a bear market, crashing, crashing. Let's go. Fast forward to today. It's 2022. 1 second. Ooh. Okay, so this is the bear market run. Now, notice this. It just gave a high break. A higher high formation is just coming into the picture. Let it just be formed. Okay. Did not, this is not picking up. Yeah, that's a higher high and a higher low. And here is where the uptrend starts. Okay. There's a higher high, higher low, higher high. Here, just to be clear, you can see higher high formation, higher low formation. When it starts going above this, that's your bull run start. Okay. And this is where we are at right now. Like this was the entry point we told in one of our boot camps also. This is our buy point right now, right? And we are in the bull market. We just entered the bull market a while back. That's in October of 2023. And it's just been going up. It's already at 70,000 or something. And it's not done yet though. Like it formed a higher high. Now it's doing a short-term reversal. Right. Higher low is being formed. Okay. This is where we are at right now. If you want to enter these markets right now, you can either buy right now, which is a good time. We'll already move to 40. Nice. It's a good time to buy into Bitcoin or let's say the entire crypto markets because of this. We are in the bull market right now. If it crosses 70,000, it's going to be another big boom up. Remember the parabolic things that we saw earlier? That is, we saw how Bitcoin just went like that, right? That's the next phase in the market. So that's what we're looking at. So I'll give you the crypto coins for you guys to start investing and timing it this also, right? Just a little while. So same thing, guys, like what we just observed, I'll just show it in a couple of stocks like IRCTC and all these things. It's the same cycle across all stocks. I'll analyze different stocks that you guys also mentioned now. But just check this out. Once it gives higher highs and higher lows formation. Okay, this is IRCTC. Let's say from here, it gave higher high, higher low, higher high, higher low, right? All of these are entry points. It already became, like, let's say this is itself, it's a uptrending zone. You can buy here or buy at these breaks also completely fine. And the result is this parabolic effect where the price just goes crazy. Okay. And then lower highs, lower low formation, price starts to crash. Now, why would we enter IRCTC? Right. This was the analysis we gave during the boot camp, but you can see it's already up. So IRCTC, again, it formed a higher high here, a higher low here. We could enter at this point, higher high. And this dip is also an entry point now. we could enter there also. Here is the next break, we could enter there also. If you want to enter into IRCTC now also, right? It already did a high break. If you want to, like now, if you want to analyze IRCTC, just if you thinking about investing into IRCTC right now, how do you check if it's a good time to buy or not? First, see where the uptrending started. Uptrending started around September of 2023. Okay, September of 2023. So 6 months is already passed, obviously, right? I think February or March is the 6 month scenario. That's already passed. This means that it's going 6 month scenario is passed. It's going for a 2 year cycle. Meaning, if this uptrend has started and is crossed over 6 months of time, the next cycle for it to meet is 2 years. That means till September of 2026. Okay, that means it has time. Let me just draw here. It has time till September of 2026 to do its 2 year cycle. So this uptrend may carry on for a pretty long time, right? So you can either buy during these breaks about 1,100 rupees level, okay, or it already dipped to the bottom. I think that was probably during the elections time, but yeah, it was already a good buy. But yeah, you can buy now also. This is how you can analyze for 1 week time frame. If you look at the same on 1 day time frame also, notice that it is forming a higher high, higher low formation. There was a this crash is mainly due to the elections, but now it's coming back up. Best safe entry point is around 1,100, or you can go even higher than that. Okay, so just wanted to give a couple of examples. Then I'll look at, then we can take your recommendations and find charts based on that. Let's again go back to the 1 week time frame and let's see which all stocks are good investments right now. Okay, so you can see this is Asian Paints. Cool. I just want to take different cases here. You can see Asian Paints lower high, lower low formations and lower high. Asian Paints is actually not a good time to invest. You can see it was in a side trending range also. The stock is not uptrending. Earlier, it was a really good stock back in 2021. You can see higher high formations and higher low formations. It was trending from around 2017, in fact. Okay, just to make this clearer, from 2017 onwards, it's uptrending start. Okay, around 2018, let's say the uptrending had started pretty well, and it's been going on a run for quite some time, right? From 2017 to 2022, or 2018 to 2023, as you can call it, it was doing a 5 year cycle. 5 year cycle meaning earlier, either from 2017 half, this is the right point. From here till the next 5 years of time, 2 year mark, it crossed already uptrend. 6 months time, it crossed uptrend. 2 years time also, 2019 also, it crossed uptrend, which means that it's going to go for a 5 year cycle. This 2022 half or 2023, right? So it did that, and now it's at this, like this is the 5 year cycle. It's almost done, and now it's at a accumulation zone. Like it could be distributing, could go down further. That's why it's not a good stock to buy right now. We can even confirm with trend line also if you just want to be a little more sure. Like we can lose the fundamentals using trend line. You can see Asian Paints, it's an expensive performer. Durability, valuation score is high, right? So both analysis is supporting the same thing, which is why we should not invest into Asian Paints. Okay, cool. Let me do one or two more examples, then I'll take up your charts so that it's clear for you guys how to do analysis. Adani Port's also a really cool example. Yeah, you remember how Adani crashed and everything. Like if you look at from a trend following methodology purpose, now you will understand that it was forming lower high, lower lows and everything. This crash was required. But after the crash, it started making higher highs and higher lows, and it started uptrending properly from here. Right, clear uptrend from there. You can see the impact also. Boom up. Right, that's Adani. Whichever Adani companies you look, you'll find the same pattern. This is Adani Enterprises. It formed higher highs, higher lows. It's been uptrending. Every break you can buy more. Every dip also you can buy more. Cool. Okay. One more stock, and I'll. Okay. Let's take a look at HDFC Bank also, right? Why people are all over the place about HDFC Bank. So HDFC Bank, it started forming lower highs and lower lows, as you can see clearly. It's been in the side trending range for a long time. Like you can basically draw a big box around this entire thing if you want. But even right now, it's not uptrending. It's not a good time to invest because uptrend has not started. It gave this high low, a higher high formation has come in. It gave a higher high formation, right? If you want to invest into HDFC Bank, it needs to come down, form a higher low, and again come back up if HDFC Bank should be a good investment. So this will take some time. Okay. All right, guys. So now let's analyze your stocks. I'm going to open the chat for a little while. Let's see. Preferably, let's find stocks which are not so common so that we can all discuss this. Cool. Chats are open. You guys can wait, it's not open yet. Yeah, it's open. All right. Great. I see a lot of things coming in the chat. We'll analyze one by one. Cool. Right. Getting spammed. Someone mentioned Geofinance, right? I'm going to take Geofinance, Suzlon, Castrol, ETH, KPI Green. All right. Switching off the chat for a bit. Okay. Uh, let's take one, which is someone mentioned Geo Financial Services. Let's take and I'll analyze that because this is a pretty good case study here. Here in these cases, right, when you don't have enough data for swing highs and swing lows, you have to go to the 1 day time frame. Cool. 1 day time frame. Mein, Geo Financial Services, as you know, it started off well. It did crash because of it was part of Nifty 50. They had to remove it out of Nifty 50. This crash was imminent. Like people had to invest over here. Now check out Nifty Geo Financial Services ka trend. Okay, uptrend and everything. Uh, Higher highs, higher low. You already know the structure. This was the last high. If you want, we can rewind the chart also, but let's save time. High, higher low. The blue line is the higher low. Okay, it started uptrending from here. This green candlestick there. That's the starting of the uptrend. Buy at that point. This green lines higher lows. You can buy more if you want. Either of these breaks or these blue lines, you can buy at these points. Okay, uptrend started, kept uptrending from around 200 rupees level. It kept uptrending all the way to around 400. Now see if it's a good time to buy Geo Financial Services or not. Okay, what we're observing here is that it formed a lower low. This was the last low. It formed a lower low. That's a warning sign already. It formed lower highs as well. It formed lower low as well. It's already in a downtrend. Okay. The stock is already in a downtrend. We cannot buy into Geo Financial Services unless it goes up from here, downs from here, goes up from here, which is not that likely. It'll take a lot of time. So if you are in Geo Financial Services already, it would be a good time to exit. If you are like if you want to keep holding for more, what I would recommend is we have to see if it actually goes up above this and this. Only then you can buy more into Geo Financial Services. Right now, the stock is overvalued. If you want to just go through trendline.com also for confirmation, just go for that also. Geo Financial Services, we can see it's an expensive performer. Stock is overvalued, right? So more and more analysis on that. Since we're on the same topic, I want to just discuss Zomato because a couple of people mentioned that. And it's a good case study for the same thing, right? So Zomato also, like on a 1 day time frame, like same thing happens in Zomato also. On 1 week, you don't have enough data to analyze it. From the start, it listed, right? You can see it was clearly in a downtrend. Clearly, it just crashed. Okay, downtrending stock. But around this time in 2023, its uptrending stocks start happening. There's not enough data on the weekly time frame on for the uptrend. That's why we're doing it to the daily time frame. Let's see how this uptrending started. Okay, check this out. Stock was downtrending for a long time, and from here around 2023 March onwards, it started again a downtrending cycle. Highs, low. Right? When you have multiple red lines on the same line, right? Consider all of them as one single high. All the blue lines as a one single low. Then it started forming higher highs, higher lows. Buy during the breakout. This is the first starting of the uptrend. Buy during the break or buy during the dips. Right? Uptrend has started around May of 2023. Cool. So at least 6 months of time would mean May to something. But yeah, anyway, it crossed the 6 months of duration. Right? From May, it's already 2024, March, April, May. Right. So it already crossed the 1 year duration also, which means it's going for a 2 year cycle. So you can see the uptrend started here, kept going up all the way till there. And there was a short reversal here, but then it came back up again. Right. So it's actually still in a good zone, uptrending. It has time till 2 years of time. Yeah. So what I mean by that is that 2023 April, if it started, we have time till 2025 April. Uptrend is not done yet. We can still buy Zomato on these breaks or the dips, right? So right now is also a good point to buy. Like it's just at an all-time high, like 207 point, like all the highs before also you can see. It's at the right point also. You can buy it right now as well. Okay, great. Let me open the chat box one more time. Let's see which all stocks to analyze. Okay, chat box is open. Let's see. If you can find good stocks, do let me know, like some unique ones. CG Power is good for semiconductors. We could analyze that. KPI Green, Shivalik B Metals, I think that's good. GTL. A lot of people are saying GTL. Okay, I see GTL. Okay. Just pausing for a minute. I'm taking two stocks right now. KPI Green is also there. Okay. I'm taking three stocks: KPI Green, GTL, and one more. Uh, okay, KPI Green, you can see clearly it's in a downtrend. Stock was uptrending for a long time. Okay, this is on a 1 week, 1 day time frame. Yeah, it was uptrending for a long time. Clearly, you can see lower highs, lower low, very clear formation. It's usually a downtrending signal. We should exit the stock, right? Uh, on 1 week also, let's just have a quick look. Yeah, 1 week may it's already uptrending. So there are two ways to analyze if the stock, if we should exit the stock right now or not. One, you can see it's already highly, it went up so much, right? It needs a correction. Like it went up from 2020. Here is where the uptrend started. 2022 half, right? So it's already 2024. 2 year cycle is done. It's aligning with the 2 year cycle, as you can see. Like 2024 around July, June is 2022 June was when it started. Right now it's exactly at 20 after June, right? 2 years is up, and you saw the reversing sign as well, right? So it already went up by almost 800% or 900%. It needs that 50% correction before it can go up again. So it's already downtrending. It would be a good time to start exiting these stocks. If you want to think about investing more into this, not a good time. Like anyhow, if you really want an investment option, higher high, higher low, higher high, then it may go for the 5 year cycle. But again, no guarantees for this. We have to, right now, it's not a good time to invest because it's downtrending. Okay. Someone mentioned GTL. Let's take a look at GTL. Right. So clearly it's downtrending, but it's coming back up. Yikes. The stock is very volatile. Oh, it's a penny stock. No wonder. It's volatile stock. Interesting stock. It already did a first expansion. Now it's going for the second expansion. What I mean by this is that earlier in 2021, it did a high low, lower highs also. Downtrend is also done. That's one cycle that's completely done. Bull market, bear market is done. But now it again started the next bull run. Higher high formation, higher low formation, next higher high formation. It's in a bull market right now. It's a good time to start loading up on these. This low point was a good buy point. Okay. Uh, if you, it's a good time to buy right now. Why I'm saying this is because go to the daily time frame. Okay. You can see that it already made higher highs, higher low, and it just went above this also. So 14 rupees, it just gave a breakout. So GTL is a good investment for penny stock expansion. Penny stocks are pretty risky, by the way. If you're investing, also invest only say 5 to 10% of your, around 5% of your portfolio into penny stocks. I'll give you the risk management figures also so that you guys can do it effectively. Let me just check out GTL on this as well. GTL Infra GTL Limited. Nice. Great valuation, good durability. You can see green valuation, good durability also. So trendline is also confirming the same thing. Keep this in your watch list, I guess. Uh, let's see how this actually goes around in the next couple of years. So GTL looks good. Yeah, a good buy point right now. Okay, let me see the chat again. Someone mentioned Indus Tower is already a good buy point. I think there was one stock that a lot of people asked for. Let me just go through. Tensor. Okay, I can't find it. Cool. Anyway, I'll open up the chat one more time. Let's see what we get. If you guys can get unique stocks, that'd be really cool, guys. USK, CG Power. Yeah, CG Power was one thing that I wanted to analyze. Okay. Yo, a lot of unique names are coming in. Very Pavana Industries. Okay. Someone mentioned Zomato valuation is high. Yeah, that could be there, but for technicals is still something that is better than that. Zomato is still in a reversal. I mean, could go either way. Wow, my chat is spammed. 1 second, guys. I need to collect my thoughts. Um, Yikes. Okay. Cool, guys. I'm switching off the chat. I'll just pick off something from what you guys have sent. Okay. Let me just quickly screen through a couple of stocks. People said Mama Earth. I'll just do that. Mama Earth. Forgot the ticker name for it. Yikes. I can't find it. Okay. USK. Someone was mentioning USK a couple of times. Let's have a look at that. Infrastructure stock, which means that there's a demand for it anyway. Nice. Good pick. Good pick. So it just gave a breakout of the recent level as well. As you can see, it just gave a breakout, so you can still buy the stock. Like it's buying the break kind of a situation. Higher highs, higher lows. You guys can see clearly an uptrend. Like first high, first low, higher high. This is the higher low. This is the starting of the uptrend technically, but even now it just gave a higher break. So let's have a look at its trend line also, which is this is USK, right? Good find actually. USK. Ooh, Trendline looks very bullish on this. You can see durability is good, valuation is good, momentum is also good. Crazy. Okay. LIC, it's already an uptrend. Vishaka, USK, Usha Martin, Mazagon. Mazagon is kind of too hot to touch right now. Like it's definitely overvalued. It may have much more potential and everything. The thing about, I think a lot of you guys will have this doubt, which is when you look at PSU bank sector or railway sector and all these things. Ooh, analysis worked very well. Nice. Uh, okay. Yeah, Mazagon is too hot to touch right now. You need some kind of a retracement for you to actually get back in the stock. Now it's just on a daily also. Yep, yep. Like if it comes back down to some 4,400 levels, that'd be a good time to buy the stock. But now it's too hot to touch these kind of stocks. But generally saying, all of these things will follow a 5-year cycle. That is, all your PSU banks and everything, after say close to 10 or 15 years, it was side trending or going downwards. It's finally doing an uptrend. So this pressure will definitely last for at least 5 years of time or 10 years of time. So when it comes to railway sector stocks or say defense stocks or even your PSU banks and everything, you still have a lot of potential for it. Keep holding the stocks. Right? Buy more if you can in the uptrend runs. But yeah, that's it. I think Ratan Tata is something that Ratan India is something that I checked out already, which was pretty good as I remember. Ratan India Power. Okay, this is downtrending now, so not that great. It was uptrending. Yeah, yeah, it still looks good though. Uh, it has hit its targets. That's one of the main worries. Like technically, it has hit all of its targets. So it might be bearish in the short term run, but in the long term run, it may still be bullish. Like it just did a around 2024, 2023 is when the uptrending started. If it's a 6 month cycle, then it may crash. But if it's a 2 year cycle, we can still hold on to the stock. I think fundamentally also this stock was good last time I remember. Let me just confirm this. Yeah, mid range performer, not bad. Okay. I think I found Genus Power. This is something that I haven't heard yet. So let me just check this also out. Genus Power. Again, infrastructure company. That's nice. I like infra companies because government of India is supporting it. Okay, so this did it was side trending, but uptrending first, then side trending, but now again an uptrend. Just giving a breakout also from a weekly base, which is interesting. Yeah, VCP pattern. Good stock, guys. This is actually, I love these kind of stocks, which does this kind of pattern. That's what we call as volatility compression patterns. It will definitely have a good gain up. So we can expect at least a 200 point move up. So around 500 rupees or something would be a price target. So good stock, guys. Good pick. This is Genus Power. Just gave a breakout. Looks good. You can look into this. Let's just confirm with trendline also, just in case. Valuation is high, but yeah, technically it'll probably just hit the target and immediately start crashing. So it'll probably just have a short-term momentum towards the upside, then it may start crashing. Still fine. Okay, cool. Opening up the chat one more time. Let's see if I can find anything unique. SteelX India. Okay. CG Power, please. Yes. CG Power is something I want to look at. It's a good stock fundamentally. G shipping. Indicator name is swing high, swing low indicator. I'll just type it in one more time if you want. It's swing high, swing low. Right. Usually we have to do this manually through our eyes, but this thing basically helps us identify the swing highs and swing lows better. Woot. Uh, there's a question that which sectors would I recommend? Generally, IT sectors and banking sectors, something has to have a bull run in the next couple of months. Like in the next 6 months of time, there should be a good run. IT sector companies, a lot of them are undervalued, like Wipro, TCS, Infosys, in the large caps companies. But yeah, IT, banking, petrochemical sector is also pretty good. That's like companies like Supreme Petrotech and a couple of them. But yeah, yikes! A lot of chats, guys. My spam, it's spammed. Okay, I'm gonna switch it off for a while. Yikes! Okay. Oh, all right. What is PE ratio? That's price to earnings ratio. It's something that is used to understand if the stock is undervalued or overvalued. Paytm. Paytm, I think it's been in a downtrend. I think it recently started trying to do an uptrend, but let's see. Whoop. Nope. Clearly not. You can see it's clearly in a downtrend. Run away from the stock. I think on a daily time frame, it's slowly trying to pick up pace, like higher highs and higher lows. But ever since that RBI ban on Paytm, it's been bad for Paytm. I would not recommend this. On weekly time frame, it's not an uptrending stock yet, so I would not recommend it. Pavna Industries is something that came up. This is in a side trending zone, as you can see it. Like just draw a box around it. There you go, distribution. So not recommended actually. Like from a weekly time frame also looks like signs of reversal. A lot of lower highs, lower low formation. These are usually weak. Like when you see three peaks like this, it's usually a reversal sign. So I would not recommend this. It may come back to 400 rupees, but yeah, not a good stock to buy more. Uh, GICRE. Okay. General Insurance. General Insurance is a public company, so I won't recommend much into general insurance. It's been uptrending from say September of last month, right? So this does have more potential to go upwards. From a general perspective, yes, it is good stock. You can buy more, no problem. If you want to time it better, let me just see a 1 day time frame. Yeah, it looks like in a good uptrending zone. Good time to buy into this GICRE. Yeah, good stock, no problem. But generally, it's a government company, right? So most often it doesn't give high returns. But yeah, I think this may give in the insurance sector, this is actually one of the leaders there. So it could definitely give some good returns. Okay, Gabriel and Gabriel. Downtrending stock just turned uptrending. Let's see weekly also. Ooh, weekly mein to it's kind of bad. Like it just gave an uptrending signal. Like it's moving its next move up, but I feel like it's overvalued. It's getting expensive. Okay, not overvalued yet. So I think there could be one more swing highs and swing low levels here. So yeah, you can still buy into it. Cool. Cast. Oh, it's already 9:45. All right. Let me give you the crypto portfolio as well, and then we can slowly start winding up the session. This looks like a sign of reversal actually. No reversal has come in yet, but if you want to just buy into the stock about 200, it can still work. If it goes only about 200 these ranges, think about investing. Otherwise, there could be a crash. Like any stock which has gone up like this, right? I'm very uncomfortable investing into it unless it has a really good correction. I see that it has corrected multiple times, but yeah, if it goes about 200, we can still look at this company, right? Cool, guys. One more. Okay, let me just do ITC as well. Someone mentioned ITC. Cool. So the main thing is that I want you guys to be in a position where you can analyze stocks by yourself. ITC, you can see it's clearly in a downtrend now. Lower high formation, lower low formation, lower high. If you're already into ITC, it's time to start exiting ITC, right? This is a clear downtrend. We should start exiting. Okay. So this is ITC. And the main objective for me, for you guys, for this is that first thing, you guys got to be understanding when the uptrending started, like time duration. If it's within 6 months of time, be careful. If it's after 6 months, if it's between 6 months to 2 years of time, you can still hold the stock. If it has crossed 2 years, then it's going to go for the 5 year cycle, right? This is how you can comfortably time the markets when it comes to market cycles. And only invest in top trending stock. Just a quick thing before you invest also, which is risk management is also very important into all of these things, right? Risk management in the sense, what you want to do is don't put all your eggs in one basket. That is, invest up to say 10 percentage per stock, which is every time you will have at least 10 stocks with you. All of these 10 stocks should be uptrending stocks, and you should have bought it during the buy high breaks or even the or dips, right? All these 10 stocks should be uptrending, and fundamentally it should be good. If it's green, it's really good. But yeah, this is not a necessity, but at the same time, I would say preferably have fundamentally good stocks by using trendline.com. These are your first two steps to make sure that you're only investing in winners, right? On top of this, even then, a lot of these stocks, right? Generally, what will happen is that two or three of these stocks will definitely go in a loss. Okay. It'll go in a loss. So it's all about cutting your losers short. Here comes the next rule. Next rule is that your max loss should be 8% per stock. Okay. Where whenever you enter a stock itself, for example, on Zerodha, if you're entering, let's say, TechM, or TechM is good, right? If you're entering TechM, you will find this stop loss option or GTT option, good till triggered. This means that stop loss is nothing but your automatic exit order. If you say minus 8% stop loss and you buy into this trade like this, whenever the stock price hits this stop loss, you will automatically exit the company or exit the stock. That's good, right? So take a max 8% loss. If at all it comes down and comes back up again, it's okay. Buy more on the dip, but 8% should be your loss limit. Like, do not cross that loss limit. I know that it's hard for us to book losses and everything, but it's completely fine. You should learn to book losses. If you take that too, since we are having 10 different stocks, right? Two or three of them may go in an 8% loss. It's fine. You can either re-enter if it's still an uptrending stock, re-enter during the dip or break of the next high. That's one option. They may go in a loss. That's fine. Okay, but two or three of them will go decent profits. Like decent profits in the sense you may give you around say 20 to 30% profits and everything. Pretty decent, nice 30% or 50% profit. But it is a rule of nature that 20% of your portfolio will always give you insane returns. Meaning some of them you will get very lucky. Okay, we'll get very lucky. This is where you can get up to say 100% plus returns into two or three stocks of those. So what we are doing is we are increasing our surface area for luck. Like, it's true that you will get lucky in the market. There are just four cases in the market, right? You either make a big loss, you make a small loss, you make a small win, or you make a big win, right? Uh, if you just cut out this big loss by making sure you have the right risk management, losing only 8% every time, then you're setting yourself up for these big wins and everything. The flip side is that if you have a big loss, you will definitely make a big win also. It swings in both directions. So we just make sure that we have everything, we have done everything right to get lucky also. Of course, sometimes everything will also go in profits, but that's just a lucky day scenario. This is the more realistic scenario where 20% of your 20% of your portfolio will give 80% of the profits. That's the rule of 80-20. Right. So I hope you guys are clear with the risk management side also now. Just make sure that you guys are investing only 10% per stock or 5 to 10% per stock. That is, if you want to, if like some people likes to have a lot of companies, right? Just maximum have just 20 stocks within your portfolio. The more number of stocks that you have, like what happens is that even if one guy gives 100% return, it won't affect your overall portfolio too much. That's why it's not recommended. Have at least 10 to 20 stocks maximum in your portfolio, right? That you can rotate out. Okay, cool, guys. So yeah, before I wind up, before I give the crypto portfolio, can I quickly get a review from your side against the session? Like, if you guys found the session useful, was it worth your time and everything? I just need to take a video for Instagram, if that's okay. Uh, can you guys let me know in the chat of how you guys felt during the session? Was it good? Worth your time, worth your money? Yes, one sec. Okay, awesome, amazing. Your time is definitely worth more. Okay, insightful, excellent, best session ever, superb. Thank you. Uh, Outstanding, amazing session. Thank you. Thank you, guys. Totally worth it. Nice. A lot of fires. Thanks for all the fires, guys. Uh, know what to say about your energy. Oh, thanks, man. Full paisa vasool. Worth interesting, worth every money, 1000%. Totally worth it. Great, insightful. Best explanation, let's say. Okay, great. Thanks, guys. Thanks a lot for the lovely reviews. Awesome. See you. Very, very useful. You should charge more. Fundamentally strong. It was outstanding. Superb session. Thank you. Rocked it. I see a lot of rockets and fires and all. Thank you, guys. Right. Big win. Definitely a big win. Awesome struck. Very informative. Thank you. Thank you. Awesome. Right. Damn useful. We love it. It's too good. Totally awesome. Great. It's just pure education. Worth it. Worth your time. Thanks, guys. Thank you for all the lovely comments. Best I've attended. Okay. Okay. Right. Share the Insta ID. Need it. Okay. Right. 1000% worth it. Got it, guys. Okay, great. Thanks, guys. Thank you for all the lovely reviews. But didn't tell your age. I'm 28 right now, so kind of getting old, but I look young. Yeah. YouTube channel. We don't do much of YouTube nowadays. We are only on Instagram. We'll slowly start off with YouTube as well. Is there any course you teach to do trading? We do have our masterclass, lifetime programs, and everything. That's more like an end-to-end solution. What's my name? My name is Akash. I'm not married yet. No. We want course. So, I mean, we'll be giving you out. How do you join the Discord server? Okay, wait. Let me just brief this out for you guys. Can you say about your memberships? Cool, cool. So this is the Discord server. You guys will be getting access to the public server of this. That is, on the public channel, we have this education channel where we break down different channel stocks and everything, like what is actually happening in the chats. Whatever trades that we take in the community itself, we'll be breaking it down so that you guys also have the perfect knowledge. After tomorrow's session, a lot of these things will actually make sense to you when it comes to intraday trading. We have the public chat option where you can just talk to us and help us with all the suggestions. Apart from this, you'll also get access to the academy side of things, where risk management, liquidity, whatever you want to learn. Let's say if you want to learn about liquidity, we have in depth into it. You can just read through. It's very fun topic. Our content writer is pretty nice. That's pretty much about the public server that you guys will be getting along with your bootcamp session. Apart from this, like Discord, we are basically like an end-to-end education service plus live trading plus funding trading programs. Like we train traders, we live trade with them every single day, and we fund them for trading as well for our long term, where they join us, our team of traders basically. This is the paid programs though, where we have these equity channels. Even if you want to trade equity market, futures and options, or forex in US, like during the live market hours, our mentors, we have a team of 7 mentors across different, specializing in different market segments. We come here live, we share our screens, we trade along with our members. So whatever we teach, we implement in the live markets and make sure that everyone trades together. Like even if you are about to take a trade, like if you want to buy into Reliance, you can just unmute yourself, ask us about analysis for Reliance. We'll tell you if it's a good opportunity to buy right now or not. So it's more like we teach them during the Saturdays and Sundays, but live market mein, we just make sure that you have the hand holding required to make sure your learning is perfect. Like we want to make sure that you become a funded trader. That's the long term objective. Profit and loss channel is there where we just show off. People just show whatever, how much ever they make and stuff. There's also the sniper shot section where what we teach, we tell them, the mentors, whatever segment they're trading. This for equity, for example, we'll tell them go long on Devyani, for example, or tell them when to exit their stocks and all these things. Stock ideas for swing is also there. This for swing traders. Forex market also, again, different sector of call outs and everything from there. We basically, in the live market house itself, it's like we teach you how to do this. We make sure that we give the live market assistance also, so that you can also start doing the same thing from you guys yourself. This is crypto market is also there. Then long-term portfolios where we review different portfolios for you guys to invest in. Let's say mining sector, power generation, petrochems, and etc. Here's the crypto thing that you guys needed also. I'll just put it in the chat. Yikes. Right. This is the crypto. So these are the crypto coins which are pretty good. You can use, I'll just put it in the notes so that you guys can check this through. Like if you want a low risk portfolio, I would recommend for Bitcoin, Ethereum, and all these things. But I would recommend going for medium risk portfolio, which is higher aggressive returns. You can use exchanges like Delta Exchange is good for Indians. There's also KuCoin, which is also exchange. Sorry, these two are the crypto exchanges which are legal in India. Binance is really good, but these are for a different segment itself. Like Binance is not completely legal in India yet, but KuCoin and Delta Exchange is compliant with Indian laws, so you can go for them if you want to buy into these cryptocurrency coins. So yeah, this is the Discord server where futures and options. If you're trading FNO also, like during the market hours, we give support for that. Forex and Forex also, we are the live market source. We give the same support for that as well. So what we have is a membership. Like we have, what do you say? We have lifetime of education. Like you can come back into classes anytime with us. Make sure that you become a. It's like 4 months of trainings and a lot of different. It's a pretty intensive course actually, pretty nice. But that's the training part of things. But apart from that, for our lifetime members, we do financial planning, like make sure that all their goals are set for their life and make sure their investments are on track. Apart from that, we have algo trading services, which is it's all part of one single membership. If you take the membership, all of this comes along with it. So algo trading is where we trade for you. We have bots in the market where you get around, like our bots are coded with the strategies that we teach, and basically we automate your trades. So you just have to put in your money, sit tight, you can just enjoy the money from later on itself. So that's the algo trading services. That's also part of the community server. So yeah, that's pretty much it. I mean, we have the app and everything for education. We have the live trading segment. We have funding programs where we make sure that you become funded trader. As you know, we are a funding program ourselves. We give funding exams where once you become a funded trader, you start with $10,000 capital, which can be scaled up all the way to $1 million capital. Yeah, that's pretty much what we do. So how to join? We'll be giving the for joining, we'll be giving forms after the market hours. I mean, sorry, after the bootcamp on Monday, we'll be putting out forms and our team will get in touch with you guys and you guys can get into that at that. What are the membership fees? So for the lifetime package, it's around 35,000, but it's actually at 30,000 after discounts and everything. Whereas if you're just one looking for the education part of things, then it's just at say 6,000 rupees for 2 months of time. Lifetime is more like we take care of you for your entire life, your financials, and make sure that you have a source of income for your life. Algo trading ROI, we usually focus for 2 to 4% ROI just in paper, but we always outperform the markets. So which is around 8 to 10%. But yeah. Uh, right. Cool. What are your charges? Parang? No, Parang used to work for us, but now he started his own company. What are your charges? I think that's also done. According to the 80-50 rule, companies that have moved up quite a bit, there's an 80% chance that stock will crash by 50% and vice versa. Why does it actually happen even if the fundamentals of the company are strong? It's because of profit booking. Like if investors have been investing into a company for a long time, if they're at a 120% profit, right? They want this profit is theirs only if they sell out of the stock. If they don't sell, if they keep holding it, right, other people will sell and they'll take the booking off. So everyone has to book profits at one point of time. That profit booking triggers the downtrend or downward movement. At that point, everyone starts exiting their trade because they know the market cycle. That's what triggers the 50% loss to the downside. Or the bear markets are mainly profit bookings and exiting out of different stocks. So can we get Discord server link for educational purposes? Yes, it will be put out in the groups after Wednesday onwards, and that's when it is. Do we have offline classes? Offline, we just have traders retreats. It's basically like the community goes to Munnar, Goa, and all these places. We just have sessions over there, but we don't have offline system as such. Uh, can you please explain fixed time trade in Forex? I would not recommend going for all these binary option contracts because it's skewed to make sure that you make them loss. Like I've seen a couple of people who are actually making profits from it, but from my experience, most of the people have only made losses in that. So I would not recommend going for FTTs. How big is your family of lifetime members? We have around 7,000 people in the community, and it's a pretty good active community. Does this logic apply on indexes as well? It does, but I would not recommend trading indices. If you're trading indices, it's mainly futures and options, right? So not recommended for futures and options. Futures and options, we would recommend smart money trading or institutional trading. That's in tomorrow's session. Okay. Tomorrow class by Ritwik. Yes. Tomorrow's class is by Ritwik. Book recommendation. I would say find check out Trading in the Zone by uh Trading in the Zone by Mark Douglas. That's a pretty good book. Okay. You never checked out CG Power? Yikes, I really have to. CG Power is a really good company, by the way, guys. It's for semiconductors and everything. So just keep a check on the stock. Yikes. Yeah, it's at an all-time high, as you can see. From 2021, it started uptrending. So it's going for a 5-year cycle, which is around 2026. We still have time, not too late. Um, I think on a daily time frame, it just gave a breakout also. I think you can buy at all the breaks and all the dips right now. Good time to buy CG Power also. Okay. Or do we get guidance for swing trades for the monthly subscription? We don't have monthly subscriptions or anything as such. Like we don't sell call outs or anything. Like we are a pure trading institution and we focus on funding traders as well. But yeah, we do tell which sectors are in rotation and which sectors are looking good. We have a pre-open market report that we give out. Like we are a pure trading firm, guys. Like we have trading research that we give into our members all the time. Do you watch F1? Yes, I do. I'm not a Mercedes fan. I know a lot of people think that, but I'm actually a Ferrari fan. Trident is also good. Well, last I checked, Trident was actually going for a long-term uptrend. So that is there. Okay. Eligible for everything if you go for lifetime thing. Yes, lifetime. We just have one package which covers everything. Like we don't charge anything separate as such. Like we believe like once you're in our program, you're part of our family and we take care of you. That's our concept. Whoa, Trident is in a downtrending zone, but I think it's going to change its trend pretty soon. It's bottoming out. It's a good time to look at Trident. Obviously, only if it goes above 42, one more swing high should be there. Like best case scenario, yeah. If it goes above 42, Trident is a good buy zone. Trident is a really good stock also. I would really suggest for it for buy, but only above 42 rupees. Yeah. Okay. All right, guys. I think okay, there's a lot of chats that I missed. Okay. Can we get recording or PPT? Yes, recordings would be given. Can we do WazirX and CoinDCX? Yeah, they are also good platforms. You can go for it. Will we get free entry in the next webinar? Yes, you guys will be added to webinar pass. Like the same webinar will be repeated every 2 weeks. But apart from that, there will be some stock selection webinars and strategy webinars also, which is usually a 1 hour webinar in that weekdays, which will be starting from August onwards, July end or August. So again, it's part of all the bonuses and everything. You'll get it. The Discord link will be shared on Wednesday also as part of the bonuses. Okay. Is there any good cheaper alternative to TradingView? There was one, but Go Charting. Yeah, I think it's Go Charting. There was one which actually gave free tools. I remember it's Go Charting, not sure. Is there any special discount for students in the membership? Yes, students also have student scholarship membership. You just have to apply for it. Uh, Again, in the forms will be given, the mentors will be getting in touch with you. Sorry, the counselors will be getting in touch with you. At that point, they'll give you all the offers and everything. Cool. All right. Best penny stock according to you? I forgot. I have a list of penny stocks. I will send that over a little later. Just send me a text on WhatsApp also, just to keep in check with me. Oh, it's chats are spam, guys. Will the current WhatsApp group be dismantled? We won't dismantle it. We'll be giving you more nurturing information and more infos about the markets and everything on that. A lot of the new future webinars also going to be coming under the same group. Okay, guys, I won't be looking at any more stocks right now. I have to close the session. I'm a little tired, so I hope you guys understand. Yeah. Great. Thanks, guys. Thank you for your time. I'm going to close the session for now. Feel free to approach me anytime over WhatsApp if you guys need anything. Right. So, good night. Take care. Thank you for your time. And I'll see you. Intraday is purely tomorrow's session. So, that's there. Okay. Ferrari won't win tomorrow. Okay. All right, guys. Bye. Thanks for joining in. I'll see you. Good night. Bye.